A very good morning, friends. So I hope all of you are doing very well. And of course, undoubtedly, your cumulative revision on the consolidation standards is going on. So last class, we started off with Index 110 and we did in detail the inputs regarding the scope of the standard. Well, I think I'm not going to spend time giving you a recall in terms of the scope, but just to give you the basic inputs. We had discussed the inputs in terms of one of the cases where the entity gets a choice. The para number 4A of Index 110 that gives you a choice, especially when you are a part of the chain holding, you are the middle company. And that's not something which is mandatory in nature, but it's a matter of choice for the company whether they want to avail the exemption provided under Index 110 and not to consolidate. Then I took you to the second area, which was a case of a mandatory exception, and that was the para number 4B, where we're looking at a parent being an investment entity. But there were exceptions where I created a three-step model for you that there are a total of 3 focus points. The parent is an investment entity, 1. The subsidiary is not an investment entity, 2. And the services provided by the subsidiary relates to the parent company's services, then that is the only case where consolidation is done under para number 4B, considering the explanations which are given in para number 31 to para number 32 of the Index 110. So we did a couple of case studies and I created some charts with you as well, giving you a clarifications on all the permutation combinations when there is no chain holding and when there is a chain holding. Then the second aspect, what we started off, and we are still in that particular discussion, is the assessment of control. And I've given you a chain of thought already, but I think we'll take a quick recap on the chain because I also need to create a chart with you on the concept of concurrent ability, which we were discussing. I hope you recall the examples which we did on the concept of a current ability, where I gave you an exposure in terms of a forward contract as well as in terms of option contract. And I said, we'll give you a little more exposure in terms of getting a better understanding of those combinations. Okay, so I think let's begin the journey with you. And I am going to first of all give you the permutation combinations. First of all, the aspect in terms of control assessment, and then take it further. Okay, good morning once again, friends. And I think let's begin the journey. So I think on the aspect of control assessment, let's give you the chain of thought. So I've already given you this aspect, but I'm just going to quickly take a recap on the 3-step model which I gave you on a control assessment. So my focus, first of all, to begin with, is going to be on a control assessment. So I said that if you look at the control assessment under Index 110, it is supposed to be a principle-based assessment. It is not a rule-based assessment, but it is supposed to be a principle-based assessment. Nowhere does the standard use any percentage in order to determine that there is a control or not. So unlike you can say the I gap, where the percentage criteria, you've got more than 50% voting power in a company and you get a control, is no longer there. But of course, the chances are much bright. If you consider that a company has got more than 50% voting power, the chances are very bright that yes, it would establish a control. But nevertheless, even if you've got less than 50, there could be a control, or even if you've got more than 50, the chances are you may not get a control. We'll be dealing with all those cases today. So as a part of the control assessment, I gave you that we're going to go to the step number 1, first of all, and do the assessment that does the investor have a power over the investee. So when we say that the investor has got a power over the investee, this also involves certain sub-steps. And I gave you that there are going to be a total of 3 sub-steps within the step number 1. When you're establishing that we've got, as an investor, a power over the investee, the first one is you need to see that there are some existing rights. I'm yet to discuss the concept of existing rights in detail, but we've got a little flavor already that existing rights could be having majority voting rights, or maybe you are a party to a forward contract where you could acquire majority voting rights, or maybe you're a party to an option contract where you go to acquire majority voting rights. So we got a little sample of the existing rights as well. Then we said the second one is that we need to look at the current ability. So we're looking at that these existing rights should give you the current ability. Now the word used is a current ability, but I made it very clear that when you're looking at the word current ability, it doesn't mean as of now. It means when the need arises, when decisions on relevant activities are going to be taken, would you be in a position that your existing rights will give you the power at that point of time? So I think let's put that focus very clear that when you're looking in terms of the current ability, we've already said when need arises. So it is not as of today, but it is when the need arises. So as we saw in the examples, that when a decision is to be taken in a scheduled meeting, so when the meeting will take place, will we as investors have the ability to exert that power? And then I gave you the third input, the third factor substep, and that is to direct relevant activities. So we should be in a position to direct, you can say, the relevant activities. Relevant activities are something which would significantly impact the returns of the investees. So when we're looking at relevant activities, let me also pinpoint that. We've already seen that relevant activities would mean which would significantly affect. So which would significantly affect the returns of the investee, sorry, which would significantly affect the returns of the investee. And if you recall, I've given you an illustrative list of examples also which are relevant activities. We said, just to quote the para for reference, the para number B11 of the appendix B of the standard gives you an illustrative list of relevant activities. So I had given you a illustrative list, not an exhaustive list, but I gave you an illustrative list of relevant activities as well. So this illustrative list, just to quote you, is given in terms of para number B11, just in case you want to make a reference on that. So we're done with the concept of relevant activities and the current ability, but I'm yet to make a chart for you on the relevant activities. And then we go to the existing rights. But before that, let me just also complete the chain in terms of the step number 2 and 3. So this is step number 1, that is looking at power. Then the step number 2 is that you are exposed to variable returns as an investor. So we need to consider that as an investor, you're exposed to variable returns from your involvement with the investee. We're here to discuss the step number 2. But once you prove that, yes, there is a power, you need to go to the step number 2 in order to prove that your involvement with the investee is going to expose you to variable returns. And then finally, in terms of the step number 3, you need to develop a linkage between the power and the return. So basically, we need to develop a linkage between the step 1 and the step number 2. So we should be able to give a linkage that yes, power and the exposure to variable returns are linked. So once we are able to conclude all the 3 steps, we say, yes, there is a control. So once we say a yes to all these steps, so once we're able to say a yes to all of them, then this would indicate that the investor controls the investee. Right, friends. So I guess my chain of thought is absolutely clear at the moment, that when you're looking at a control assessment, you got to go in a very sequential order. You need to first of all look at the concept of power with 3 elements: existing rights, which I also gave some nicknames just to remind you, as I might use them today as well, that I use the existing rights as ER, the current ability is CA, and the relevant activities is RA. So I always say that power is supposed to be a blend of ER, existing rights, CA, current ability, and RA, there is relevant activity. So if you're able to prove ERCA as well as RA, then we can say there is a power. Then you go to step 2, exposure to variable returns, and then step 3, a linkage. Once all are a yes, it is undoubtedly a case of control. Okay, so far so good. Let me just see if there are any questions coming in. Otherwise, I think we're ready to make a chart on the current ability. Okay, I think that was a quick inputs given by Namrata. That's wonderful indeed. That's a good revision. Okay, so now let's do one thing. Let's make the chart which was pending on the concept of current ability. I'm going to make a little more exhaustive chart so that we can get all the permutation combinations. So let's make a beautiful chart to you. So let me just add the chart on a current ability. So this is my chart which I am creating on the concept of current ability based on the examples which we discussed in the previous class. So let's have a look at the chart on a current ability. So as we said that in those examples, the focus was current ability, but we also saw the concept of existing rights. And of course, the meeting which was supposed to take place was also considering that we are going to direct relevant activity. So I think let's create a wonderful chart now. So let's take a column for particulars. So I'm going to create one column for particulars, the permutation combinations. One is the existing rights. Then one is the current ability. And one is the relevant activities and the remarks. Okay, so I think we can take one case as majority rights. Then I guess I can take another one as a case of forward contract and then options. So I think we're going to create a wonderful permutation combination on this. Okay, let's begin the journey. So let's take one column for particulars. And I'm putting short forms. This is existing rights ER, current ability CA, relevant activities. And then I need to give that there is a power or not. So the power is there or the power is not there. That's what we're going to decide. Now, recall the examples which we did in the previous class with you, where we saw the first example where the investor has majority voting rights. We did the first case where the investor has majority voting rights. So can I say, is the majority voting rights and existing rights? Yes, undoubtedly yes. So if an investor already has majority voting rights, it is considered to be an existing rights. One. Second, we knew that the meeting is going to take place in a period of 30 days. So I think I just want to put that the meeting is supposed to be in 30 days time, as per the example which we did. So if you've got majority voting rights today, there is existing rights. Will it give you the ability in 30 days time to exercise your power? Yes. Unless there is anything to the contrary, and to direct relevant activities, yes. We were very clearly given that this meeting is going to be for the purpose of taking decisions on relevant activities. So in the meeting, direction of relevant activities is going to take place. So is there a power? Yes, there is a power. So that was the first variation which we did. Then we came to the second variation. And in the second variation, I covered the case where you've entered into a forward contract. Where you've entered into a forward contract, and this is to acquire majority voting rights. So this is with reference to that we are a party to a forward contract, and as a party to the forward contract, you are going to acquire majority voting rights. So is that considered as an existing rights? Yes, of course. So will it give you a current ability when the meeting takes place or not? So we said one thing very clear, In terms of a forward contract, you do not have an option to exit. You have to honor the contract, whether it is a gain or it's a loss to you. You cannot exit out of the contract. So the only thing to be seen is the settlement date is before or after the meeting. So I would say there are two permutation combinations taking place. If you can say that the settlement, if you say that in this case, you need to compare the settlement and the meeting date. So when is the meeting? And when is the settlement of the contract going to take place? So there are two permutation combinations which could arise. The settlement is before the meeting, or the settlement is after the meeting. So these are the two permutation combinations which could arise. So if the settlement of the forward contract is going to take place before the scheduled meeting, in this particular case, definitely we can say, yes, a current ability would arise. But if the scheduled meeting is going to take place after, so by the time the meeting takes place, you would not have majority voting rights. So the current ability is missing. Relevant activities is, of course, a yes. And here I think we don't need to do the analysis. So in the first case, this is a yes, this is a yes, and this is a yes. So the power would come. But in the next case, if you see that this is a yes and this is a no, so the power will, of course, not come. I think this chart will give you a bird's eye view on the concept of a current ability, making life simple. I think so. Okay, now let's go to the third existing rights combination, which we did with you. And that was with reference to that we are a party to an option contract. We are a party to an option contract, and this is to acquire majority voting rights. This is to acquire majority voting rights. So this was a third case which we did, that as an investor, we are a party to an option contract to acquire majority voting rights. Is that an existing rights? Of course, yes. So this is again an existing rights. Now, we need to be careful on the current ability levels. So let's get the chain very clear before we create the permutation combinations with reference to the option contract. Now, in terms of the option contract, there are two things which you need to clearly see. One is that the investor may or may not exercise the option. And if he exercises the option, the settlement is going to take place before the meeting or not. Unlike a forward contract, you're looking at only one parameter, that when is the meeting and when is the settlement taking place, because you don't have an option to exercise or not to exercise. You have to. But in terms of options, since the investor has got a choice of exercising or not, so there will be two parameters. One is that will you exercise or not? And then if you exercise, is the settlement date going to be before the date of meeting or not? So watch this carefully. So we said the various permutation combinations is that I can say it is in money, or I can say it is at money, or I can say it is out of money. This is, I'm taking as one block. So when the investor makes an assessment regarding the option contract, he would say it's in money, it's at money, or out of money, or I would say that it is a case where it is deeply in money. We can say it is deeply in money. And the fifth combination is that it is deeply out of money. So I would say these are the 5 permutation combinations which could arise out of an option contract. Now, the moment you say it is in, at, or out money, you cannot say with a certainty that you will or will you not exercise. So I would say, if you remember, I said in the previous class as well, that this particular combination is something which is judgmental. Therefore, if you look at the examples with the standard setters gave, they gave only one example where we can undoubtedly say the investor would exercise, and that is when it is deeply in money. So I would say in case of in, at, out, I would simply put it that this is something which involves a complete level of judgment. So you cannot give a conclusion and say that, yes, we would exercise or we would not exercise. So even the standard setters did not give an example on this area. The only example they gave was when it was deeply in money. Okay, now if you say that it is deeply in money, then we would say, yes, we will exercise. Yes, we will exercise. And in this particular case, you need to go back to the same agenda. I would say you need to go back to the same agenda in this particular case. So we can say that if you're looking at this permutation combination, go back to the same case after yes. When is the meeting going to take place and when is the settlement of the option contract? And accordingly, you take the decisions. So it is deeply in money and the settlement is going to take place before, then yes, the power will come, otherwise not. So after this, the status remains the same. Now, when you say it is deeply our money, then we are saying that no, we will not exercise. So if you're going to say in this case, no, we are not going to exercise, then I would say there is no power. There is no power. So in an option contract, we can see three permutation combinations coming in. If you say it is in at out money, I would say it involves a judgment. We need more additional facts to take a decision. If you say it is deeply our money, I think we've decided that we're not going to exercise, so the power will not come. And it is only one situation that it is deeply in money. You would say, yes, I would exercise. And then you need to see the meeting is before or after, and accordingly reach a conclusion that the power is there or not. I hope I made myself very clear on all the permutation combinations on a current ability. Right, friends. So I think so far so good. I think this should work very well. Okay. So my step number 1B is done. My step number 1C is done. I've given you a detailed analysis of the relevant activities. I've given you a very detailed analysis on the concept of a current ability, that what are you looking at a current ability is that if your existing rights are of different natures, what kind of parameters would go at the back of the mind. The basic crux is that you need to see that once the meeting takes place, would you be in a meeting? Would you be in a position to exert your power? With the help of the existing rights, would you be able to take decisions on the relevant activities? If yes, you've got a current ability. Okay. Now let's go on to the step number 1A. So we're still on power, and within power, we are on the element that is, you can say, existing rights. Now, watch me very carefully, because what we are about to discuss now is a little chain of thought which I'm going to give you. So we're going to give you a chain of thought. Don't worry, we're going to do a couple of examples to make it very clear. But let me first give you the chain of thought for step 1A. So let's have a look at the chain of thought. Let's get the chain of thought in terms of step number 1A. So I'm focusing on the step number 1A, that is on the concept of existing rights. So I'll first give you a chain of thought so that we are very clear in terms of how we're going to proceed in terms of step number 1A. So hear this very careful, friends. The next 5 minutes is crucial in order to get the understanding how you need to think. Now, I would say, considering the examination aspect, I would say that when you're looking at the existing rights, I would say the existing rights can be broadly classified into two categories. So I would say if you're looking at existing rights, I would say there are basically two kinds of rights. One is, we can say, rights which arise on account of voting power. So the first kind of rights we are looking at, that it stems out of voting power. So if you've got voting rights, so let me not put it as voting power, let me call it as voting rights. So let's call this as voting rights. Generally, in a company, the decisions are always taken on the basis of voting rights. So power stems out of voting rights generally, but there could also be, you can say, the power. There can also be a power which arises from the right to appoint, or remove the right to appoint or remove the KMP, the key management person. Now, let me tell you one thing. Though it's nowhere written in the standard, but this is more or less a practical reality. Then let's say, for example, an investor has got no voting rights, but he's got only the right to appoint and remove the KMP. So without any voting rights, it is a little difficult to say. Theoretically, yes, we might say that, if you've got a right to appoint and remove the KMP, yes, you've got a power which could lead to the effect of control. But generally, in a practical life, it would be very difficult without the presence of a voting right, just on a standalone basis, saying that if you've got the right to appoint and remove the KMP, then I would say you get a power. So you could see that in terms of control assessment, either only this is there, or you can say this plus this is there. So solely an right to appoint and removal is not going to give us that power. So either we have got purely voting rights, it could work for assessment, or it's a combination of voting rights with the power to appoint and remove KMP, then that combination could work. Now, let's concentrate on the voting rights. Now, I would say there are two kinds of permutation combinations which could arise as far as a voting rights is concerned. Either as an investor, you've got majority rights, or you have less than majority rights. So we can say that as an investor, you already have majority voting rights. Or we can say we've got less than, or as an investor, we've got less than majority voting rights. So these are the two combinations which could arise. Now, when I say that you've got more than majority voting rights, generally you should be able to get a power, but still there could be two permutation combinations. There could be still two permutation combinations. You've got majority voting rights, and I say that yes, you've got power. Or I say you've got majority voting rights, but I lead to a conclusion that no, there is no power. So the combination one is that as an investor, you've got majority voting rights and a power, or you've got majority voting rights, but there is no power. I would say unless mentioned otherwise as a fact, as an investor, if you've got majority voting rights, it definitely implies power. So this is one case which we can say unless mentioned otherwise, this is true. So I would say this is unless mentioned otherwise. If there is nothing which is to the contrary, then we can safely assume that if you've got majority voting rights, it certainly implies the presence of power. But what is the case when you've got majority voting rights and still we are not able to say that we've got a power? What happens sometimes, what even the standard setters have put that in the standard, and they say that, sometimes your exercise of the right is subject to the approval by regulatory authorities. Like, for example, you might need a permission of the court. So, for example, if your exercise of the voting right is subject to approval by the court or any other approving authority, then in those particular cases, even if you've got majority voting rights, it's more like a paper kind of rights with you. Because every time you want to exercise something, you need a permission. So we can say in this case, it will be clearly given that it is subject to approval. If your rights are subject to approval by a court or any other approving authority for that matter, then we would say, even if you've got majority voting rights, we do not have any power. Now, the crucial case comes in because, if you look at the first combination, this is a truth that yes, jiski lathi, uski bhains. The second one is subject to approval. So it is very clear that you cannot get a power if something is subject to approval. You need a permission every time. So naturally, you don't have a power. But the critical case comes in that if you've got less than majority voting rights, then how would you prove that, yes, you've got a power or not? You've got a control or not? So in this particular case, we need to make some assessment. This is a case where we need to make some assessment. So you need to assess. Now, let me give you that when you're going to make an assessment in this particular case, what kind of permutation combinations could arise? Now, watch these combinations very carefully. So when you're looking at less than majority voting rights, I would say the permutation combinations could be into 5 parts. So you could see a total of 5 permutation combinations which could arise in this particular case. Now, as an investor, you've got less than majority voting rights. But along with that, mind the word carefully, but along with this, you enter into a contractual arrangement with other vote holders. And it is something, which I always call this as a coalition government, Gadbandhan Sarkar. Like for example, you're not able to attain a majority in terms of the seats in election. So what do? You enter into a contractual arrangement and create a coalition kind of a government. A similar kind of combinations could work out here. So we can say that apart from less than majority voting rights, you enter into a contractual arrangement. You enter into a contractual arrangement with other vote holders. So there is a contractual arrangement with other vote holders. So you decide that we're going to act together. So if you decide that you're going to act together, then yes, a control could arise. Now, at this stage, let me also create another chain of thought at your mind. So when you say that, as an investor, you've got less than majority voting rights, and you've also entered into a contractual arrangement with the other vote holders, well, I would say this is a confirmed case of power. Because let's say, for example, you've got a 40% voting rights in a company, and you join hands with another investor. Let's say you've got a 15% voting rights. So your 40 plus 15% of the other investor put together makes it a 55% combination. So I would say the moment you are under this combination, it is definitely a confirmed case of power. So let me also put it like this, that the moment you come into this permutation combination, so I would say this is definitely a confirmed case of power. You don't need to apply much mind. So the assessment is going to be pretty simple, that your voting rights less than majority coupled with other vote holders mix a combination of more than 50, then I would say, yes, it is a confirmed case of power. Now let's have a look at the second combination in this case. The second combination is that you've got less than majority voting rights. But along with this, you've also got the right to appoint or remove the KMP. So you've got the right to appoint as well as remove the KMP. So you've got the right to appoint as well as remove the key management person. So as I said, a combinations could work. So in this particular case where you've got two kinds of rights, you've got a voting rights below 50, but you've also got the right to appoint and remove the KMP. Well, I would say in this case, it is not a confirmed case of power. You'll have to look at the facts very carefully and apply your judgment. And, the answers could differ if I change the facts of the case. So it's not a clear-cut case where you can say, yes, there is a power. So I would say in this particular case, again, there is going to be a judgment. So this case is also going to involve a lot of judgment as well. You cannot say that it is a confirmed case. You'll have to look at the facts of the case and then decide that is this combination resulting in a power and a control or not. Okay, that was a second combination. Let's have a look at the combination number 3 now. The combination number 3 is that you've got less than majority voting rights. But along with this, you've also got what we call potential voting rights. You've also got, let's say, what we call potential voting rights. Now, when I say potential voting rights, that means you might be a part of a contract, or you might be holding an instrument which will be converted into ordinary shares in the future. So let's say, for example, I've got some convertible debentures in the investee. Any kind of convertible debentures would mean the possibility of conversion into ordinary shares in the future. So maybe when the scheduled meeting is going to take place, the conversions of these instruments will take place and you would get a majority voting rights. So in this particular case also, you cannot say that it is a confirmed case of power. because those convertible debentures, which gives you an option to convert into equity shares or an option to get a cash, it depends upon the facts whether you will exercise the right to get cash or you will exercise the right to get shares. It all depends upon the facts of the case. You cannot say that the presence of a potential voting rights would undoubtedly confirm that, yes, I've got a power. So I would say this is again a case which is going to involve a judgment again. So I would say this case involves a judgment, and even this case is going to involve a judgment in this case. Okay. That was a combination number 3. Let's look at the combination number 4. Now, in terms of the combination 4, you've got less than majority voting rights and there is nothing else. There is nothing else. But I always call this as a case. It's like I say, Andho mein kana raja. Like the first case, I call it as Gadbandhan Sarkar, a coalition government. In this particular case, when you've got nothing else except less than majority voting rights, I always say, Andho mein kana raja. If everybody is supposed to be a blind person and you are with one eye, then you are considered superior compared to the other. A bad example, but I think a good one to understand the concept. So in this particular case also, I would say it is not a confirmed case of power again. This is again something which is going to involve a judgment. So we're going to see how do we evaluate the facts. So this is again going to involve a judgment. So majority of the cases, when you've got less than majority voting rights in a company, would be cases when you'll have to apply judgment, look at the facts of the case and then decide. Okay, then finally, we've got a 5th combination as well. And in the 5th combination, we are saying that it could be plus any other permutation and combination. So which means it could be a case of less than majority voting rights, maybe with a bit contractual arrangement, maybe a right to appoint and potential voting rights. So it could be a mix of all the cases. So if you say this is 1, 2, 3, 4, so it is plus any other permutation combination. It could be a mixed criteria in this case. A bit of potential voting rights, a bit of right to appoint and remove the KMP, it could be a blended case. I don't think so this kind of a combination could come in the exams. Because as it is, I've not seen a question in the exam where you are given to do a control assessment, but nevertheless, if you're studying the standard, if you don't know what is a control assessment, then what's the fun in terms of understanding the standard? So this is, of course, for your knowledge as well, because cases when it gets judgmental generally would not be coming in the exams, because that kind of judgment could be, a different answers by different people. Everybody's got a different kind of judgments and they could fight out their cases. Anyway, so this is again a case I would say is completely based on a judgment again. So let's get the chain of thought very clear, friends, on the existing rights. I hope I am very clear on the thoughts. I am basically teaching you how to take a judgment, which is a very difficult task in life. Trust me, it's very difficult to teach people how to take decisions which involves a judgment. But today, I think I'm getting the honors of, teaching you how to take a judgment based on the facts of the case. Okay, so now I think, but the examples which are given in the standard are quite, cases where you cannot have a different judgment. I think if you apply the concepts in the right manner, then I think the possibilities are that, everybody is going to lead to a same conclusion itself. Okay, so let's get the chain once again very clear before I proceed taking examples on this chain. So let me just consolidate the learnings at this stage. So no worry, I think you'll get a lot of examples supporting this as well. I guess a few questions coming in. Namrata, you said, so if there is a right to appoint but don't have a right to remove, then, well, I guess in this particular case, there are no combinations which are given in the standard, because, invariably, when you get a right to appoint, you get the right to remove as well. And I think if you get a right to appoint and not removal, I think it's a very dangerous combination to me. I would generally say that you don't get a power in those cases, because you can make the person sit on the seat and you can't remove him, then he can take decisions against you. He's not going to take decisions in your favor if he knows that after appointment, he's not answerable to you. You'll appreciate the fact. You make me sit on a chair. After that, I don't need to listen to you. I'm going to do things of my own free will. But I am going to listen to you only, if you can appoint me and you can remove me as well. So I think solely appointment is quite dangerous indeed. Okay, I think in the fourth combination, we said, let me just, I think, come back to the entire chain of thought once again. So let me remind you, friends, we are on step number 1A. That is the concept of power for control assessment, which means we're looking at what we call the existing rights. Now, we've said that as per the standard, we can say there are basically two kinds of rights. One is, you can say, a voting rights, a power generally stems out of voting rights. But there could also be another kind of right, and that is the right to appoint as well as the right to removal of the KMP. As I said, if a company has got no voting rights but only right to appoint and remove KMP, it is difficult to prove the concept of power. So it can be, a solely voting rights, or it could be a combination of voting rights with a power to appoint, then that could give a power. Now, there are basically three permutation combinations as a main exercise. When you look at a question, you're going to see that, okay, do you have majority voting rights? Yes, implies power unless mentioned otherwise. Number two, you've got majority voting rights and it is subject to taking approvals and permissions from the court or other authorities. You don't have a power. These two cases, of course, cannot come because they do not involve any judgments, no assessments, very plain vanilla cases. The third one is the most important, that you've got less than majority voting rights, but still there is a power. But still there is a power where you've got less than majority voting rights. So our main concentration in terms of example is the third combination where you've got less than majority voting rights. So what else? What else do you have which will prove that you've got a power? One is that you enter into a contractual arrangement with other vote holders. So when you as an investor with less than majority and some other investors, put together, mix a combination of more than 50, I would say it's a confirmed case of power. Then you can see the second combination is that you've also got the right to appoint and remove the KMP, which is judgmental. We'll have to see the facts. Simply because you've got below 50% voting rights with a right to appoint and remove KMP doesn't mean that you've got power. We'll have to look at the cases. The third combination is that you've got certain other potential rights. You've got investment in convertible debentures and preference shares, which would give you, once those convertibles get converted into ordinary shares, you might get a power. The fourth combination is that you don't have anything else except less than majority. You've got nothing else. So we need to see that what kind of circumstances would be there that you've got 48% stake in the company. Then what are the kind of facts that we're going to see in the practical illustration? But, we'll have to see and apply our judgments. And then there could be a fifth case, a permutation combinations, where we can say that, okay, it could be less than majority with, let's say, a contractual right, a right to appoint, or maybe a little bit of potential voting rights, whatever. Okay, I think now we are ready to go to some examples with you. So we're going to see some examples to get the judgments clear. Let's begin the journey. So what I've done, I've taken some examples which are given in the appendix of the standard to make things very clear. So I am now going to take you to a few examples at this end. So let's begin the journey. And I'm going to take some examples. Watch it very carefully. I'm going to take around 5-6 examples with you to make the picture very clear. So watch this carefully, friends. Watch this very carefully as we go. So I'm going to create the chain of thought very clear. So based on the thoughts which I've given you, I'm going to give you the conclusions in this case. Okay, let's, I think, begin the journey. It says investor acquires a 48% voting rights. Immediately what comes to the mind is less than majority. So let's see what other combinations are there. It says the remaining voting rights are held by thousands of shareholders, none of them individually has got more than 1% voting rights. Let's not read it further. Now, please hear me very carefully. This investor has got a 48% voting rights, and all other shareholders have got not more than 1% individually. It says rest of them are thousands of shareholders and nobody has got more than 1% voting rights. And it also says that none of the shareholders has any arrangement to consult any others or make collective decisions. So even the other stakeholders don't have any kind of contractual arrangement with each other that they will always act collectively. Now, I would say, which case is this? I would say this is my fourth case. Nobody has got more than 1%, which means I am andho mein kana raja. Every other investor is having a very small stake in the company, not even 1%, and I am the only shareholder with a 48%. But you cannot say that this confirms that I've got a power. It all depends upon the fact how active the other stakeholders are when the voting exercise are exercised. When the company has a meeting, it all depends upon what is the level of participation of these scattered number of shareholders who've got less than 1%. So I would not say that this is a confirmed case of power, but I would say yes, we need to get some more facts. But apparently, it seems that the chances are that, considering his relative comparison, mind the words, considering his relative comparison as compared to the others, if everybody is a small shareholder and I am 48%, naturally, as compared to the others, considering the size of your investment, the chances are more bright that you might get a power. But I would say you need to still look into more facts. You need to still see that when the meetings takes place to take decisions on relevant activity, what is the level of participation of these 1% stakeholders as well? How many people turn up? Like, for example, just to give you an understanding, let's say there are 48% with him and the rest is 52 people, let's say, with one each. Now, what happens in a meeting? Majority of these people don't even turn up. Let's say when a meeting takes place and you look at the past trends and you realize that these people don't turn up in the meetings. So what happens? That more or less he is present in the meeting. So what he says is, undoubtedly agreed by the others. So I would not say that if you're close to a 51, a 48%, it is a confirmed case of power. You need to look at the facts, but the chances are bright that when your size relatively compared to the other investors is so big, the chances could be that you could get a power. Let's see the facts now. So it says in this case, when assessing the proportion of voting rights on the basis of the relative size of the other shareholdings, the investor determined that 48% would be sufficient to give it control. In this case, on the basis of the absolute size of the holding and the relative size of the other holdings, the investor concludes that it has got a sufficiently dominant voting interest to meet the power criteria without the need to consider any other evidence of power. So as I said, that, based on the facts, they are just telling you that with a 48% stake, if you look at your absolute size, 48, and if you look at relatively in comparison to other people, 1%, and I'm relatively also bigger, absolute bigger, relatively bigger, chances are more bright that I get a power. But I'm still saying that it doesn't mean that it's a confirmed case of power. It is judgmental. You need to look at the facts. Then when the meetings takes place, what is the level of participation of these particular shareholders? Do they actively participate? Do they abstain from the meetings or not? And accordingly, one could take decisions. But still, nevertheless, considering the apparent facts, the chances are brilliant that he gets a power. I hope I am clear with the judgmental part of things. Okay, so far, so good. So let's take it further. Let's go to the next example. Okay, now I'm taking you to the example number 5. Let's have a look at the example number 5 now. Okay, so let me just clear this part a bit and let's go to the example number 5. So let's see the facts of the case. It says investor A has got a 40% voting rights, and there are 12 other investors which each have got a 5% voting rights. So A has got a 40%, and there are 12 investors which has got 5% each. That makes it a total of 100. So on one hand, you've got 40%, and there are a total of 12 other people with 5% each. Now, let me first of all trigger your thoughts. There is some guidance which is given in the standard, and I think it's important to tell you that. If you're considering that these 12 people will collectively join hands and they will be able to attain a 60% stake, then they would easily outvote this 40% investor. Anybody would think that 12 people would collectively join hands and create a cartel, and they get a 60% stake in the company, and they would easily outvote this 40% vote holder. But I think it's not easy. But I think it's not that easy in this case, because the possibility of 12 people joining hands together is a little difficult. The standard also has given us a guidance in the appendix, and it says more the people required to outvote you, the chances are that you've got a power. I repeat, the standard very clearly says that more people are required to outvote you, the chances are they cannot snatch your power. But lesser the number of people, who could snatch your power are there, the chances are that you lose power. So we'll see in one of the next examples as well that, let's say, if only 2 people together are able to attain more than a 50% stake, the chances are quite brilliant that they will join hands together. Even if they don't like the faces of each other, the chances are they will join hands together. Because दोस्त का दोस्त दोस्त होता है और दुश्मन का दुश्मन दोस्त होता है. So if you look at a combination where you see that only 2 people could join hands together, then they will definitely kick this investor out. But 12 people joining hands is a little subjective. I don't say that they will not join hands, but the possibility of their joining hands is a little lesser. Okay, then let's see further. Then he says there is a shareholders agreement grants A the right to appoint, remove, and set the remuneration of the KMP. Wow. So I think this is a combination of a question where you got less than majority voting rights and the right to appoint a KMP. So the first example was you had nothing except 48% rights. And this is an example where you've got less than majority voting rights, and you've also got the right to appoint and remove the KMP. Let's read further. It says to change the agreement. So the agreement gives him the right to appoint and remove the KMP. To change the agreement, a 2/3 majority vote of the shareholders is required. If anybody wants to take away the right to appoint and remove the KMP, they need at least a 2/3 majority. 2/3 majority would mean 66.67%. Aha. So if they need a 2/3 majority, that is 66.67%, how are the other investors going to achieve that? Since he has got a 40% stake in the company, that means the remaining stake is only 60. Even if all those people stand against him and they want to snatch away the voting rights, they will not be able to do that. Because in this particular case, they can't achieve a 2/3 majority to remove him, which means what? That he has got a 40% voting rights along with the right to appoint and remove the KMP, which nobody can snatch away from him. So I would decide who's going to sit on the seat to take a decision. I think with the facts of the cases, it definitely seems that he would get a power, even though he's got less than majority rights, because he's got the right to appoint and remove the KMP, and nobody can take away that particular right, because 2/3 majority cannot be achieved. So in this case, investor A concludes that the absolute size of the investor holding and the relative size of the other shareholdings alone are not sufficient. So if you just look at the fact that he's got a 40% stake, that is not enough to prove. That is not enough to prove in this particular case that he gets a power, but he adds on in this particular case It is not conclusive in determining whether he gets the power or not. However, A determines that its contractual right to appoint and remove the key MP is sufficient to conclude that it has got a power. So in this particular case, we can say it is definitely subjective, because simply if you get a right to appoint and remove the KMP, it doesn't mean that you're getting a power in this particular case. I think let's do one simple exercise further. In my main chart, let me also relate the example so that once you revise, you know that in this combination, this example is going to work. Good idea. So the example number 5, I can relate it back. So let me just come back and relate it out here. So example number 5. So I can put it out here. If you're looking at the example number 5, you can refer the example number 5 out here. This fits in so that once you revise, you know that in this case, you can see example 5. And this is what we did example number 4, which was on the situation that you got only a 48% right. So that would correlate the things. This was judgmental, but we saw the facts and said, looking at the absolute and relative size, you get power. This was again judgmental, but considering that nobody can remove you from the right to appoint, remove KMP, you've got power. Okay, let's go to the next example. So let's have a look at the next example, and let's see the example number 6 now. So let's have a look at the example number 6 and see which combination is working in this case. It says A is got a 45% voting rights of the investee, and there are 2 other investors who've got 26% each. Aha. I think I won't want to read anything further. You've got a 45% stake, which is less than majority, and there are 2 other investors, 26% each, and they join hands together. And they will be able to get a collective control because 2 people, 26 into 2 makes it 52%. And I think even if they don't like the faces of each other, you would understand they would not like to be dictated by one fellow. So they would definitely join hands together and outvote this particular investor. As I said earlier, that in the previous example, which we saw, 12 people joining hands together, the possibility is less. But 2 people joining hands together to outvote this particular investor, the possibilities are more. So I think considering only the facts in this case, with a 45% stake, I don't see the possibility of the investor getting a control, because only 2 people joining hands together would get a collective control and outvote this particular investor. So it says the remaining voting rights are held by 3 other shareholders, and each of them has got 1 person. So we can say he's got a 45%, 2 investors with 26%, and 3 investors with 1%. That makes it 100. So in this particular case, I think these 2 investors make it 52. So I would say in this particular case, they will easily outvote the person with a 45% voting rights. That's it. So it says there are no other arrangements. In this case, the size of the investor A voting right and the relative size are sufficient to conclude that he does not have a power. Only 2 other investors would need to cooperate to be able to prevent A from directing the relevant activities. So you can see that in this example again, we are in a situation which is again the same case, that apart from less than majority voting rights, I don't have anything. But you can see compared to the example number 4. In example number 4, you saw that you had a 48% stake and everybody was widely dispersed. Nobody had a stake, more than 1%. Contrary to the example number 4, in this example, you can see just 2 people can just simply outvote you. So the 4th and the 6th example should make things very clear. We'll quote that example number 6 as well. Let's go back. And I think in this case, let's, put this as well. So you can also add example 6 and do these examples collectively. When you look at the example 4, what comes to the mind is less than majority, but everybody else is 1%. Chances are more bright, yet you get a power. Then example number 6, you can see 45%, but 2 people with 26% each can easily outvote you. Those 1% people can't join hands together. But these two people can definitely join hands together. So that's the contrast in example 4 and 6. Okay, so far so good. So I think we've seen how we are going to create a judgment. Now let's go to the next example with you. So let's have a look at the 7th example now. So let's have a look at example number 7. So let's have a look at the example number 7, and then we could look at the example number 8 as well. Let me see in the meantime if any questions coming to your mind so far. Okay, no, I think that's great. I don't think so there would be any major issues coming at the mind. I think things are not complicated at all. Let's read example 7. It says investor is got a 45% voting rights of the investee, and there are 11 shareholders with 5% each. So you've got 45%, 11 investors with 5%, mix it a total of 100. I think it's the same case. Just like one of the cases where there were 12 investors, we said it is difficult for them to join hands. And I would say even in this case, I think it seems difficult that they will join hands. But nevertheless, I don't deny the possibility of 11 people joining him. I'm not saying that the 11 people cannot get a collective control, but it's difficult. So I think if you don't give me any other inputs, I would say I need more facts. I need to see that, when a meeting takes place, what is the level of participation of these 11 shareholders as well? Do they actively participate in the meetings? Do they vote in favor of the investor, or do they always go against him? Is he able to achieve that kind of majorities or not? So I think it is definitely judgmental in nature. So then it says, none of the shareholders have contractual arrangements to consult any other. So in this case, the absolute size and the relative size of other shareholdings alone are not conclusive in determining whether the investor has sufficient rights to give it a power. Additional facts and circumstances may provide an evidence. He's made it subjective, and he said simply, if you give me these facts. Now, if you look at the example number 5, verses 7, you need to compare 4 and 6, and you need to compare 5 and 7. In example number 5, you could see that when it was a case that you had a 40% stake and 12 investors with 5%. So we said it was as good as example 7. So in example number 5, if you remember, there was a right to appoint and remove the KMP. But for the moment, let's assume that if there is no right to appoint, remove a KMP, I would say it was completely judgmental. You need to see that what is the level of participation of these 12 shareholders when meetings to take decisions on relevant activity arises. And now if you look at the example number 7, you can see that he's got a 45% stake and there are 11 investors with a 5% stake. And there is nothing else. So you can see that example 7 is like a subset of example number 5, because it is only a certain voting rights below majority, judgmental. So I think in this case, we can say definitely you need more facts. Here, since the right to appoint the KMP was there, which nobody could snatch away from you, it was a case where we could conclude that yes, power can arise. But here in this particular case, considering that you've got nothing else, 11 people joining hands together seems to be difficult. We need more inputs to decide whether you get a power based on your absolute and relative sizes or not. So let's fit in this example number 7. So we putting this example number 7 back on the chain. So on my chain of thought, example number 7 also gets inserted here. But I would say when you are going to look at the example 7, do correlate this with example 5 for a better understanding. So 4 and 6, you must do a comparison. 5 and 7, you must do a comparison to get a clarity. But these examples are falling in this case because the investor does not have anything else with him. Okay, so that was example 7. Let's go to the example number further. Let's go to the example number 8 now. So let's have a look at the example number 8. And then we've got 2 more examples which are going to deal with the potential voting rights, which is not a very difficult one to analyze. Let's see the example 8. It says investor has got a 35% voting rights and there are a total of 3 other shareholders, each having a 5% voting rights. So you've got 35%, you've got 35% voting rights. And then it says with 35% voting rights, there are another 3 shareholders with 5% each. That makes it 50. That makes it 50. So even if everybody joins together, you're working on a combination of only 50%. So investor has got a 35% voting rights and 3 other shareholders with 5%. The remaining voting rights are held by numerous shareholders, none of which has got more than 1% stake. So you can say the rest is numerous number of people. Nobody has got more than 1% stake, widely dispersed. I think in this particular case, again, it is difficult to make any conclusion that you've got a power. I think I need more facts of the case, because even if these people join hands together, you don't achieve a majority. And even if these people go with the other widely scattered people, I think getting a collective control with so many widely dispersed people is a big question mark. I think in this particular case, we need more facts of the case to decide things. But let's see further. None of the shareholders have got arrangements to consult each other, etc. Now, what it says that we need approval of majority notes. We need a 75% voting rights to take a decision. He's very clearly now told you that if you want to take decisions, you need a 75% voting rights. Do you think there is any possibility that this investor could achieve a 75%? Or do you think these 3 people could achieve, or these widely dispersed people would achieve? I would say no. If the company has put that clause that you need a 75% majority to reach decisions, I don't see that this investor can anyway get a control. In this case, see what it says, the active participation of the other shareholders at the recent meeting indicates that the investor would not see that he cannot get a control. So we go to the example number 8 and do the mapping. So now I think a quick look at the chart to get the fundas very clear. You can see the majority examples which are given in the standard are relating to the combination where you've got nothing else except less than majority. So let me just, I think, do the consolidation at this stage on the control assessment. You can see this case is a confirmed case of control. So there has been no example on this area, because I think anybody can do that mathematics, add the 2 percentages and see it's more than 50% or not. So there are no questions on this area. We got only one question on this area, and it was such a safe question with the facts that if you've got less than majority and the right to appoint, remove KMP, and nobody can snatch away that rights with me, I think it's a very clear-cut case that yes, I definitely get a power. Very clear-cut, because removal rights cannot be snatched away by anyone else. Then we saw the cases in example number 4, where we said that in absolute and relatively, you got a 48% stake, everybody else has 1% each. The chances are more bright that you get a power because everybody is widely dispersed. The example number 6 we saw was a case of, you've got 12 investors. It was a case of, people, 2 investors with 26% each. So they could outly, the facts were so clear that they could easily outvote you. The example number 7 was 11 people together. So we needed more information because 11 people joining hands together is a difficult exercise. And then we looked at the example number 8, where the criteria of 75% to take decisions was so high that it is difficult that any investors could achieve that combination. So it was a clear-cut case of no power. So example number 6 was a clear-cut case of no power. 2 people could outvote you. Example 8 was a clear-cut case of no power based on the facts of the case, because in this particular case, the criteria of 75% was too stringent. Example 4 was quite indicative that you get a power because everybody is too small in front of you. And that's how we decided. Example 7 was purely subjective. We needed some more facts to take a decision. Okay, so far so good. Now we are going to do, let me tell you in advance, example 9 and example number 10. These are going to be devoted to the potential voting rights. So you can see examples are given on this combination, and this. No mixed combinations. and no combinations on contractual. So the standard has given us all these things, and these kind of examples are given in the study material as well. And once you go through the control assessment, you're going to see all these things. Let's go to the example 9 and example 10, which is containing the concept of potential voting rights. Now, before I take the example 9 and the example number 10, let me also give you a little more insight further on this. Let's give you a little more insight further on this. I don't think so there would be any questions coming in so far. Good morning, Panu. So I think so far nothing coming in further. Okay, let's take the journey forward. Let's go to example 9 and example 10. Now, before I take the example number 9 and 10 with you, let me create another chain of thought in terms of potential voting rights with you. When I'm looking at the concept of a potential voting rights, let me tell you one thing. First of all, I need to consider my potential voting rights as an investor. I need to consider other investors' potential voting rights as well, because their potential voting rights could give them power later on, and my potential voting rights could give me power later on. So there could be two kinds of situations. I am a majority vote holder right now, and the other investors have got certain potential voting rights, with the help of which they will convert me from majority to less than majority. So I need to watch out that other investors' potential voting rights may snatch away my majority position. Or it could be the other way around, that let's say you've got less than majority voting rights, but with your potential voting rights, you may become majority. So the possibility is that from a majority, you become a minority because of the other people's potential voting rights. The possibility is that from a minority, you become a majority because of your potential voting rights. So when you're looking at the potential voting rights of the investor, you need to see and you need to also see the potential voting rights of the other investors as well. Let's see the example number 9 based on this. It says investor A has got a 70% voting right, so he's already a majority voting right. Maybe now other people may have certain potential voting rights, converting it from 70% below 50. It says investor B has got a 30% voting rights, as well as now the other investor B has got an option to acquire half of the investors A's voting rights. So B is entered into an option contract with A, where he would be able to acquire 50% rights of A. So if he's able to do that, he's got 30% and he gets another 35%. So he will get a 65% stake if he is able to exercise the option. Now, I think if you recall our discussions in the morning, you would easily vouch me that in this particular case, the option is deeply in money or not. That is one criteria. And the second is that, is this option going to be exercised before the scheduled meeting or not? Because we need to see the current ability as well. But this question is not going to focus on the meeting date. This question is definitely going to focus on the fact that this option is in at out or deeply in out money. So we need to see that. It says the option is exercisable for the next 2 years at a fixed price and is deeply out of money. It is deeply out of money and is expected to remain so for the next 2 years. I think he's already given me an input with which I can decide. Since the option which B has got is deeply out of money, he is not going to exercise that option. If he's not going to exercise the option, he will be able to maintain a 70% voting rights in the next 2 years as well. So which means he will definitely get a power only because the potential voting rights of the other investor is something which is not deeply in money. So deeply out of money. So it says investor A has been exercising and is actively directing the relevant activity. In such a case, investor A is likely to meet the power criteria because it appears to have a current ability to direct the relevant activities. I think that's pretty simple and straight. Looking at the position of the other investors' potential voting rights, we can say he's not going to exercise. A is definitely going to get power. Let's have a look at another example, that is 10. So ninth one was concentrating. Ninth one was concentrated on looking at the potential voting rights of others. And 10th one is looking at the potential voting rights of the given investor. So the standard set is a beautifully given the examples. One is looking at the rights of the other investor, and the second looking at your own potential voting rights. Let's have a look at example 10. It says investor A and two other investors, each has got a 1/3 stake. So everybody's got a 1/3 stake. So the three investors with 1/3 each, that makes it 100% stake. Then he says the investee's business activity is closely related to investor A. So what the investee does, the business is closely related to the investor. In addition to the equity instruments, investor A also got debt instruments convertible into ordinary shares at any time for a fixed price that is out of the money, but not deeply out of the money. Now, whenever the case of potential voting rights would arise, where the investor gets an option to convert them into ordinary shares or not, you have to look at the status that is there a possibility he will convert or not? Is it in at out money? Is it deeply in or deeply out? Now, in this example, he very clearly says that it is out of money, but at the same time, it says that it's not deeply out of money. So when it is out of money, you are going to have a judgment time. You'll have to apply a judgment and see that if it is supposed to be, out of money, the chances are he may or may not exercise. Out of money doesn't mean a confirmed case that you will not exercise. You'll have to look into the other facts to decide whether it is advantageous to exercise or not. It says if the debts were converted, A would get a 60% voting rights. That's one. And A would benefit from realizing synergies if the debts were converted into ordinary shares. Now, you can see the facts of the case is quite indicative that, the investor would definitely exercise the potential voting rights. Now, there are 2-3 valid reasons why would we reach that conclusion. Number one, the business of the investee and the investor are closely related. Number two, the moment he exercises this option, he gets synergic benefits. And number three, he gets a 60% stake getting a control. So I think considering the facts that they're in the same business, your conversion would mean synergic benefits and you would get a 60% stake. I think the facts are indicative that even if it is out of money, the chances are that a person would, pay a little premium, even if it is out of money, and go for a conversion, because I think paying a little extra and converting those into ordinary shares is going to give you synergic benefits. So maybe the level of synergic benefits is much more as compared to the fact that it is out of money. And therefore it says investor A has got a power over the investee because it holds voting rights with substantive potential voting rights that gives it the current ability to direct the relevant activities. Wow. So I think I have taught you the art of taking judgments. I've given you the art of taking judgments, and we've learned the aspect of how a control assessment under Ind-AS 110 is done. But we're done only with step number one. We're not done with all the 3 steps so far. We're done only with the step number one, that is power, where I've given you a complete exposure on existing rights. I've given you a complete exposure in terms of current ability as well as relevant activities. Now we need to go to the step number 2 and 3 before the concept of control assessment is taken care of. So let me now get your chain of thought, friends, and tell me what is your, and remember this synergy means ek or ek 11. So when 2 people join hands together, you get the synergic benefits in that case. So synergies would mean that joining hands together would mean more economic benefits arising in ek or ek 11. That's what the phrase goes. Okay. You said, are these examples in the study material? Yes, they are in the study material as well. Okay, now I want you to quickly, before I go to the step number 2 and 3, give your scale of, your comfort zone on a scale of 10 regarding your assessment of of control. So what is your, scale of comfort zone only on power? We yet to complete the control assessment, but I think the main step is done. So give yourself a scale of 1 to 10. What is your comfort zone on power assessment? Okay. So in the meantime, now let me go back to the step number 2 and the step number 3. So power is done. Now let's go to the step number 2 and step number 3. So we're now looking in terms of the step number 2, that is exposure to variable returns. Okay, I think 9, Namrata, that's wonderful indeed. That's great. That's great. Okay, so let's, I think, take this further. And I'm sure my other friends also are quite comfortable on the agenda, because not many people are comfortable giving themselves a comfort zone score. But I believe, I think, yes, the comfort should be there. Okay, you said, sir, exposure to variable return. Yes, we are coming to the step number 2 now. That is exposure to variable returns. Now watch this, very simple. So there is a concept of exposure to variable returns. I'm putting it as VR. You'll understand that I'm looking at variable returns. Now watch this carefully. I'm going to create 2 combinations in order to make you understand the concept of variability of return. Now watch this combination carefully. You're going to see something very interesting in this standard now. Let's take 2 permutation combinations to give you an understanding of what is the concept of variability in terms of returns. Now watch this. Let us consider that we are looking at existing rights, and I'm looking at the current ability, and I'm looking at the relevant activity. So this is all a part of power. And I'll work the step number 3 as well. And I'm looking at the second step, that is exposure to variable returns. And I'm also looking in terms of the third step as well, that is linkage, so that I can decide my step number 3 as well. So I'm going to cover my step number 3 also out here, and then we'll take the remarks whether there is a control or not. Now watch these examples carefully. I'm going to take 2 examples to make the chain very clear. So if this is clear, you get the entire understanding. Let's take 2 simple examples to understand this bit. Number 1. Let's say as an investor, you've got majority voting rights. Let's say your existing right is that you've got majority voting rights. Unless mentioned otherwise, will it give you a current ability to direct the relevant activities? We've already seen a yes. That if you've got majority voting rights, unless mentioned otherwise, you will get a current ability to direct relevant activities. Now, what do you get on these ordinary shares? If you've got majority voting rights, it means you are holding ordinary shares in the company. You've got ordinary shares in the investee. So what does the concept of return on ordinary share means? That you're going to get dividends. So when you're going to get a dividends, is this something which is fixed in nature, or is this something which is variable in nature? Undoubtedly variable. You know, the quantum of dividends, the quantum of returns which you are going to get on ordinary share is not something which is fixed, but it is going to vary. So can I say this is definitely going to be variable in nature? So as an investor, are you exposed to variable returns? Yes, the company may earn profits, but you may not get a dividends. So the level of returns, that is the dividends which you're going to get from the investee company, is exposing you to variable returns. So the step number 2 is met. Now, if you say, yes, there is a power, and if you say, yes, there is an exposure, you would say, yes, there is a linkage as well. So if the step number 1 and step number 2 is a yes, the step number 3 is a yes. If step 1 is yes, there is a power, step 2, yes, there is an exposure, step 3 is a yes. Any one of the step is a no, linkage is not there, simple and straight. So you need to answer the step 1 in a yes, you need to answer the step number 2 in a yes, then I would say the linkage is automatically a yes. One of the step is a no, the linkage is not there, that's it. So when you say yes to all the 3 steps, we can say yes, it definitely implies a control. Now let's look at another example in this case. Let's look at the second example. Let's say that you have got less than majority voting rights. Let's say you've got less than majority voting rights, plus you've got, let us say, convertible debentures. Let us say you've got convertible debenture, which is deeply in money. The chances are very high that you could convert these convertible debentures into ordinary shares at a later date. So you've got less than majority voting rights coupled with convertible debentures, potential voting rights, and the chances are that you will definitely exercise the potential voting rights. So is that an existing right which will give you a current ability? Yes. To direct relevant activities? Yes. Now let's focus on the step number 2. Now, if I ask you that in terms of the ordinary shares, you're going to get a dividend. And in terms of the convertible debentures, you're going to get interest. So if I say that the return which you're getting from the investee company is in the form of dividend and in the form of interest on those convertible debentures right now. Now, if somebody were to say that what is a dividend, I would say it's a variable return. But if somebody were to say that what is an interest, I would say it is a fixed return. The interest which you get is supposed to be fixed. So which means dividend is supposed to be something which is going to be variable in nature. And the interest which you're going to get on the debentures is something which is fixed in nature. So are you exposed to variability of returns? The answer is a yes. Sir, you just said that dividends is variable and the interest is fixed. And when you said that are you exposed to variable returns, what did you say? You said, yes, you're exposed to variable returns. Are you in your senses, sir? Did you rightly said the words, yes, yes, I am in complete sense. And I have said that this is a variable return, this is a fixed return, but you're definitely exposed. You're definitely exposed to variability of returns. Sir, how are you exposed to variability of returns? What are you saying? I'll show you something very interesting. So this fixed return will be considered as variable for the purposes of this standard. So, but how come a fixed return means that you're exposed to variable returns? I would now like to show you something very interesting which is stated in the standard. And I want to actually show you the language to make it very clear. You're going to love the language, what is given in the para number B56. And I want to show you that exact language in terms of variability so that you're able to appreciate the larger picture. Have a look. Have a look at what is stated in the para number B56, and you'll get the deeper meaning of step number 2. See an example which says out here, for example, I'm reading the example which is given. It says, for example, investor holds a bond with a fixed interest payment. Investor has got a bond with a fixed interest payment. The fixed interest payments are variable returns for the purposes of this Ind AS because they are subject to a default risk and they expose the investor to a credit risk of the issuer. Oh my God. Can you appreciate that bit? I'm not saying that you're getting a fixed return. I'm saying you're exposed to variability of return. Imagine if the investee company is unable to pay the fixed interest because of a credit risk. They are not in a position to pay the fixed interest. Are you not running a risk in terms of credit risk? Are you not exposed to a credit risk by the issuer that if it defaults the payment, you don't get a fixed interest? It is not a matter of getting a fixed or getting a variable return. It is a matter of exposure to variability. I know what you're thinking at this stage. You would say, so this would mean that everything is exposed to variability. Getting a fixed returns would never ever mean that you're actually getting a fixed return, because even if you invest in the most safest kind of instruments and you're getting a fixed returns on those instruments, you're definitely exposed to a credit risk, which is a default committed by the other person. Yes, you are. And that's the reason I wanted to show you. But it also very clearly says for the purposes of this Ind AS. So please don't take this interpretation in terms of the other standards. This standard makes it very clear. And I think the standard setters had one thing very clear in mind. They never said in the step number 2 that you're entitled to. that you're entitled to. Because if you ask me a question, are you entitled to a variable returns? If you're getting a fixed interest on the bond, I would say, no, you're not entitled to a variable return. The word used is exposure and not entitlement. So I think that enlightens us on the word entitlement and exposure. You got the picture that in this example, if I say the investor is entitled to a fixed interest, yes. Is he exposed to variability of returns? Yes. So the word is not that what you get entitled to. You're entitled to a fixed interest payment, but you're exposed to variability because of the credit risk. Therefore, the moral of the story, if I go back to the example, and in this particular example, which I was discussing, that are we exposed to variability of returns? I would say you're entitled to a fixed interest, but you're exposed to a variability. You're exposed to variability due to credit risk. The credit risk means the risk of a default by the investee. If he defaults in making a payment of the interest, in that particular case, you're exposed to variability of returns. And in this particular case, we can now give a conclusion that the power is a yes, exposure is a yes, the linkage becomes a yes, and the control is a yes. That is the reason I took two different examples. In one of the examples, you could see the exposure and entitlement both are variable. When you get only ordinary shares, you're entitled to variable returns and you're exposed to variable return. But there is a difference. When I say you're entitled to a variable return, it means dividend itself is fluctuating. But when you're exposed to variable returns, you're exposed to the risk that even this return could vary. And here again, in terms of the interest, you're entitled to a fixed interest, but you're exposed to a variability of the returns. Therefore, the exposure is there and the linkage is there and the control gets established. So my step number 2 and my step number 3 is done. Wow. I think we've understood the larger picture in terms of things. Okay. Now let me see if any questions are coming in mind. I think nothing so far. All great. Wonderful. So if you remember, I started off my journey on Index 110 and I started the journey in terms of 3 inputs in hand. I said the first thing is I need to give you an exposure on the scope of the standard. That was section 1. Then I said we're going to give you an exposure in terms of control assessment, and I've given you the control assessment. Now I think let's have a quick look at one of the questions with you. Then we'll go to the third section with you, and that is in terms of how do we consolidate. So before that, I think with all these learnings, let's take you a bigger question, which is one of the questions which came in RTPs. And I think I just want to quickly read the facts of the case to you, and let's have a look. So there is a very interesting question which came in the RTP, and I think I want to take you to that question. With so much of understanding, I'm pretty sure you will be able to appreciate the larger picture of this question. So let's have a look at this particular question. We will read this question to you. This question came in the RTP in May 2019. This was the only question which I have seen so far on the concept of a control assessment. It's a beautiful question indeed. May 2019. Let me zoom it a little further. It's going to take a little time to read the question as well. So we're going to first read the question carefully, and then we're going to take the call. So I think I'm just going to read the question carefully with you. I think by the time we're read with the question, your conceptual understanding what I've developed so far is going to easily help you in answering the question. So let's begin the journey. Then we'll give you a break after the end of this question and then start with the consolidation procedure. It says Angel is adopted Ind AS with a transition date. So they've adopted Ind AS with a transition date that is 1st April 17. I guess if you know this or not, transition date is when the index is adopted for the first time. So you can say the current year in the question would be 1819. So prior to the index adoption, it followed the accounting standards notified under the company's AS rules, hereafter referred as the IGAAP. It is made investment in equity shares of pharma, a listed company engaged in the business of pharmaceutical, and the shareholding pattern of this company is given. Now we're given that Angel has got a 21% stake in this company pharma. And you can also see that little Angel, it says refer the note number 2, is got a 24% stake. So let's see the note number 2 before we read it further. First of all, in note number 1 says that none of the shareholders have entered into any agreements, so there is no contractual arrangement between the other vote holders. Little Angel is a subsidiary of Angel under Ind AS, in which it has got a 51% stake. So that means Angel along with its subsidiary, because Little Angel is a subsidiary of Angel. So we can say both the companies together have got a 45% stake in pharma, which of course means less than majority. So we are under less than majority. So we can say Angel is the parent of Little Angel. So the parent and the subsidiary together has got 45% stake in pharma. Then there is a Wealth Master Mutual Fund, and note 3 says that it is not a related party to either Little Angel or pharma. So that's an unrelated investor, nothing to do with any of these companies. And in the individual public shareholdings, note number 4 says they represent 17,455 individuals, and none of them has got more than 1% voting power, widely scattered. So you can see that he's giving you the pattern of the shareholding, that as an investor along with his subsidiary, you've got a 45% stake. And you can say then there are widely scattered people, 52%, and 3% with another investor. So we now need to see that coupled with this, what kind of combination is going to work. So let's read it further. So this is the initial inputs. Now I think let's have a look further and let's read. I think I just need to take you to this chart. Okay, so let's read the facts further. I need to clear this bit. So let me just clear this out. So right now the facts are given that you've got a 45% stake in the pharma company. Now let's see what are the other inputs given. It says all the commercial decisions are taken by directors who are appointed by a simple majority vote of the shareholders in the AGM. So the decisions are taken by the board of directors, but who is going to sit on that seat is decided by simple majority. Now, simple majority means right now, Angel with Little Angel does not have a majority. So we need to see the other facts. Now, he is giving you that in the last 3 years of AGM, what has happened? Angel Limited attended and voted in favor of all resolutions, same in the next year and same in the next year. So he's been a very active participant in terms of attending the meetings and voting in favor of the resolutions. Little Angel also follows exactly his parent company's footsteps. Now we need to see how the other investors are acting. You know, if you remember, when I did the question number 1 with you, the example number 4, where we saw that you got a 48% stake, I said, you know, you need to see how active the other participants are. How does the other vote holders, you know, actively participate in the meetings? And that's going to decide the fate. Then he says in the Wealth Master Mutual Fund, he's attended and voted in favor of all resolutions except the reappointment of retiring directors. He says every time he is acted a little differently when it comes to reappointment of retiring directors. So he doesn't appoint the same people every time. He attends the meeting and he participates in those meetings, but resolutions where the reappointment takes place, he is a little indifferent in that. He doesn't take everybody, you know, everybody proposes the same name. He says no. Then he says, if you look at the individuals, 7% of the individual shareholders attended the meeting. They're almost like 17,455 individuals with almost 1%, and merely 7%, just merely 7% attend the meeting. Rest don't even participate. He's got a 3% stake and only 7% out here are attending. and all the individual shareholders voted in favor of all the resolutions, except that 50% of the individuals voted against the resolution. So even out of these 7% people, only around 50%, 3.5%, they don't vote for the same people of director. So you can say 3% of these people and almost like 3.5% of the individuals, they don't vote for the directors being reappointed. 6.5% practically going against things. Then he says 8% of the individuals are attending, 6% of the individual attending, everything rest of the data is exactly same. That only 50% of those attending the meeting vote against the reappointment. Now, I think with the facts of the case, you can see when a meeting takes place, the retiring directors are to be reappointed. Little angel says, yes, go ahead. हमारी बंदे हैं, इनको रीअपॉइंट कर दो. थोड़ी सी ये लोग वॉइस रेज करते हैं 3% वाले, थोड़ी सी ये वॉइस रेज करते हैं 3-4% वाले. Do you think that 3% held by one of the investor, 3-4% held by those individuals, their raising the voice is going to be that high that they will be able to outvote in terms of what angel and little angel decides? You decide and give me your inputs on that inference. So you decide and tell me, what do you think on that end? Do you think those people with just merely those kind of rights is good enough? Let's have a look further. Let's see what further inputs are given. 3 and around 3.54% people, do you think they will be able to raise that much of a voice where I would need to listen to those people? I think the percentage is too less to listen to them. Pharma has obtained a substantial long-term borrowings from a bank, and the loan is repayable in 20 years. And as per the terms of the borrowing, the following actions by Pharma will require a prior approval of the bank. So they've taken some funds from banks, and the bank says that you need to take some approvals from us. It says when you pay dividends to the shareholders in cash or kind. So they say every time you pay a dividends, boss, please take my permission. And then it says buyback of its own equity shares. So dividend decisions, buyback are quite relevant decisions. So the bank authorities are telling them that when you take decisions, you need to first consult us. That's rightly said, Janvi. Issue of bonus shares, amalgamation, obtaining additional loans. So they are saying that when you take these kind of decisions, please tell us, take our approvals before you take decisions on these particular activities. Recently, the board of directors proposed a dividend of 5 rupees per share. However, when the CFO of Pharma approached the bank for obtaining the approval, the bank rejected the proposal, citing concerns over short-term liquidity of Pharma. So the board of directors, they said, the banking people said, sorry, you can't pay a dividend. Having learned about the developments, the directors of Angel, along with the directors of Little Angel, approached the bank with a request to reconsider its decision. The directors urged the bank to approve a reduced dividend of at least 2 rupees a share. The bank categorically refused to approve any payout. Now, one would, feel that the bank is being involved in the decisions to pay dividend, which is a very relevant activities. But do you think the bank's decision on refusal to pay a dividend is something which is substantive, or do you think it is merely protective in nature? The bank has given you a 20 crore rupees of money, a huge amount of money has been put in the form of loan to your company. And naturally, it is more interested in looking at the liquidity position of the company. So its refusal in this particular case is something which I would say is merely a protective right on the part of the bank. So I think if I consider that this is a protective right, such kind of protective rights cannot snatch away the decision-making rights of Angel and Little Angel. So I think there are two things which are given in the question. One is that the other investors, low participations in the meetings, and very less people, contradict them in the meetings, and the bank's refusal to pay a dividend, which is purely a protective right in nature. I don't think so it will snatch away the rights of these Little Angel and Angel. I think they will definitely get a control. Under IGAP, Angel was classified pharma as an associate because he had below 50%. So with the rule-based concept, we concluded that it's an associate relationship. But I think now with the principle-based assessment, as the CFO, you're required to comment on the correct classification. I would say it is definitely a subsidiary considering the parameters. Now, you would say, how are you going to present the answer in this case? You can refer the RTP because the detailed answer is given. If I start, writing the answers, it will take a lot of time. But you need to explain the concept of power. You need to explain the concept of exposure. You need to prove the linkage. And you also need to prove that the banking rights on refusal to pay dividends is merely protective in nature. So once you frame that answer, you need to explain that in a three-step model. So please do refer the answer in May 19 RTP, and you will get a detailed analysis of how it has been answered. So I've given you the basic insights of how you need to actually interpret the inputs given in the question. Right, friends, so far so good. Now, this takes care of the control assessment. There is another area which is given in the study material and the standard, where the control assessment has been explained. And that is in terms of when you're looking at mutual fund companies. Now, considering that that area is never come in the exam, even this has never come in exams, I think I'm going to keep it as a C category for discussions at the moment, because we've got limited time to cover up things. So what I'm going to do now, I'm going to enter my third area of discussion with you. I had identified three sections in the standard. First is the scope, which is done. Second is the control assessment. Then comes the third area, where we're going to discuss now how consolidation is done. A very important area. But I think before that, we need to give you a break so we understand the consolidation process practically. We'll start the concepts today, but we're going to heavily practice things with you tomorrow. And let me also tell you, friends, that the class which is there on Tuesday gets a little preponed, and that would be on Monday. So we've got 3 consecutive days with you: Saturday today, Sunday, and Monday. So instead of Tuesday, we're going to get a class on Monday. Okay, so I think so far so good. I think, give you a break, friends, at this stage. It's almost around 8:47, so 10-12 minutes, I join you back. Enjoy your break. Then we start with the practical consolidation. Enjoy your break. Friends, so I hope you relaxed your mind, and I think now we can enter the third phase of discussion with you. That is, how do we make a consolidated balance sheet to begin with? So I'm going to first of all take some very basic understanding. I guess many of you might be quite aware of how a consolidation is done, but I have a little systematic step-by-step procedure in terms of doing consolidation so that nothing goes wrong. So I'm going to take some few examples of my own and starting from a very scratch on how the consolidation is done so that we understand the logic as well. And then through that, I'm going to develop some rules for consolidation. You heard me correct. I'm not talking of principles on consolidation, but I'm talking in terms of certain rules which we're going to follow for consolidation point of view. So let's begin the journey. And I guess let's start with how consolidation is done. So I'm going to first of all take you to a simple little examples understanding the consolidation technique. So just watch this carefully, even if you've got background in terms of how consolidation is done, you would still get a better inputs in this case. So watch me carefully. I'm going to take a total of 4 cases with you. And through these 4 cases, I'm going to develop certain rules as far as consolidation is concerned. Let's begin with this. So I am considering, first of all, a case number 1. This cases will give you the logics, how consolidation is done, what is the basic logic. Now, let me tell you something in advance. Certain things which I'm about to do might not be in agreement with Ind AS. So I'm cautioning you in advance that what I'm doing may not be technically 100% correct, but don't worry, we'll do the corrections later. But right now, just let's get the basic logics clear. So I am considering, let's say this is the balance sheet, a T-shaped balance sheet for convenience, as far as the parent and subsidiary is concerned. And let's see, this is the consolidated balance sheet. So I'm looking at the balance sheet of the holding company, the balance sheet of the subsidiary, and I'm looking at how the consolidated balance sheet is prepared. So I'm just going to take some arbitrary figures to give you the process of consolidation. So let's take some arbitrary information to understand the consolidation. Let's consider this is equity share capital. There is other equity and current liabilities. And let's say there is a PPE in terms of NCA, and there is a current assets. Let's keep the balance sheet simple and straight. So let's say the PPE is to the extent of 200, the current assets is 100, the current liabilities are 50, and this is, let's say, equity share capital 100. So I think this is coming to 150. Okay, so this balance sheet is agreed. And let's consider we've got a PPE, and you will also have an investment in the subsidiary company apart from the current assets. And let's consider the equity share capital, other equity, and let's consider the current liability. So let's consider that the investment is to the tune of 300. The PPE is, let's say, 300. The current assets, let's say, 200. The current liabilities are 100. The share capital is, let's say, 200. So this is, I think, 800. So this is, I guess, 500. Okay. So this is the position. That's 800, 800. Yes, the balance sheet is agreed. Now, friends, watch me carefully. I'm just going to give you the technique of consolidation. If you're able to get this, you'll get a lot of things to do. The logic of consolidation will become clear. Now, in this case, I have certain presumptions which I like to pinpoint clearly. Number 1. I'm considering that the holding company has got 100% stake in the subsidiary. That's 1. So there is no NCI. So we're considering that there is 100% stake. And this is the balance sheet which is on the date of acquisition. This is the balance sheet which is on the date of acquisition. I'm doing a consolidation on the acquisition date itself. So let me give you the chain of thought in advance. In case 1, I am doing consolidation on balance sheet date, consolidation on date of acquisition with no NCI. I put it again, get the focus very clear. In the case number 1, I'm focusing on consolidation on date of acquisition, no NCI. Case 2, I will do consolidation on date of acquisition with NCI. Then I'll do a case number 3, consolidation a little later, a year or 2 years later with no NCI. And the 4th case I'm going to do where there will be a consolidation later with an NCI. The 4th case is the comprehensive case where you're going to see the presence of NCI and the consolidation which is done later than the acquisition date. So let's look at these 4 cases. In the next almost, I would say 20 minutes or so, 25 minutes, you're going to get a complete hang of the technique of consolidation, trust me. Then we're going to make some steps, and on that basis, we're going to do some questions with you. Okay, let's begin the journey. So when I am looking at consolidation, number 1, the first question what comes to the mind is, if I put across a question to you that what is the net assets of the subsidiary, or what is the equity of the subsidiary on the acquisition date? So one of the possibility is that when you take the net assets, you take assets minus the liability, or you can alternatively say that this is the equity or the net assets. So I can say this is the net assets, or you can say the equity of the subsidiary on the acquisition date. The parent company paid a total of 300 to get a control over this company. Now, let's look at this in a mathematical manner. You paid a total of 300 to get a control over this company. And what do you get in return? You get a stake in the equity, or you get a stake in the net assets, that's 250. So you paid a consideration more than the share in the net assets. So you get a net assets 250 against a consideration of 300. So we can say the difference 50, which is the premium paid, is supposed to be a goodwill. Simple and logical. Now, in this particular case, now imagine on a mathematical level, what you've technically done in this particular case, you have taken the net impact of this figure and these 2 figures as goodwill. So mathematically, this cannot appear in the consolidated balance sheet. So what you've done, a consolidated balance sheet is like merging the 2 balance sheets. And if you've taken the net impact of the 3 figures, now these 3 figures cannot appear in the console. So remember, I've got my very first rule already. My first rule is that the equity share capital of the subsidiary does not appear in the consolidated balance sheet. The other equity of the subsidiary does not appear in the consolidated balance sheet. And number 3, the investments in the subsidiary does not appear in the consolidated balance sheet. I'm giving you the logic. So we know that as far as the share capital of the subsidiary is concerned, it would never appear in the balance sheet, consolidated. Investments would never appear in the consolidation, and the other equity, which is there on the acquisition date, would never appear in the consolidation. So 3 basic thumb rules develop. Investment not to appear, equity share capital of subsidiary not to appear, other equity on date of acquisition not to appear. This is a thumb rule. Remember that. The logic is because the impact of these items is gone in the goodwill calculation. Brilliant. Trust me, friends, my balance sheet is done now. Now, what I need to do in terms of the balance sheet is simply aggregate all the assets and liability, add the assets to assets, add the liability to liability. So you can aggregate the PPE. 300 plus 200 makes it 500. Aggregate the current assets. 200 plus 100 makes it 300. Aggregate the liabilities. 100 plus 50, that's 150. In any case, now the share capital and the other equity of only the parent company would appear in the console. Subsidiaries, equity share capital, and other equity cannot appear in the console. So we take the equity share capital, that is 200, and we take the other equity, that is 500. I guess the balance sheet should agree. Everything has been taken care. So this is 850, and this is 850. The balance sheet is done. Wow. So we've got some basic rules in hand, and I think I've got 4 basic rules as of now. Let me tell you the 4 basic rules, or rather, let's give you 5 rules. Let's give you a total of 5 rules at the moment. On the basis of this case 1, I've developed 5 rules. Number 1, you can say the equity share capital of the subsidiary does not appear in the console. 1. The other equity of the subsidiary on acquisition date does not appear in the console 2. Then you can say goodwill appears as a separate line item, that's 3. And number 4, you aggregate all the assets and liabilities of the holding and parent in full. Aggregate them 100% and show it in the balance sheet. So 4 rules we've got. And sorry, the number 5, investment doesn't appear in the balance sheet. So you've got 5 things to be remembered. Don't worry, we'll document them later. Investment not to appear in the console, equity share capital subsidy not to appear in the console, other equity on date of acquisition of the subsidiary not to appear in the console, goodwill appears as a separate line item, and you can say aggregate all the assets and liability. I guess, friends, I am 100% clear, not even 99.99, 100% clear. Let's go to the case number 2. We're just going to introduce NCI in the second example. So in the case number 2, I'm taking the same case. It is same as case 1. It is same as case 1, except that I'm changing the percentage. So same as case 1, but we would consider that the holding is got in the subsidiary, let's say 80% stake. I just want to introduce an NCI to the extent of 20%. That's it. Everything else is being kept 100% the same. Just want to introduce NCI. So what I'm doing a consolidation on the acquisition date with an NCI. Okay, now let's watch this. Now, in this particular case, let me directly make the consolidated balance sheet to you. So let's have a look at the consolidated balance sheet. So let me take you back and let's have a look. So as I said, technically, I might be doing certain things which are not technically correct, but don't worry, we will improve upon the corrections later. Now, if you notice that you've acquired, I'm taking the same figures, don't want to change the figures. Let's say you've acquired an 80% stake at 300. You can't compare 300 versus 250. You can't compare 300 versus 250 because 300 represents 80%. And you can say that 250 represents 100% of the net assets. So what you can do in this particular case to get it very correct, when you're calculating the goodwill, this goodwill, as you've learned at PASNA. So if I take the NCI, let's say at PASNA in this particular case, we will get an NCI that is proportionate share in the net assets. So 250 is the net assets, like take a 20% of that works out to the extent of 50. So we take the total 350, compare it with the net assets now, which is 250. So we get a goodwill to the extent of 100. So we get a goodwill to the extent of 100. So basically, my calculation of goodwill is taken the NCI at PASNA in accordance with Ind AS 103. Okay. So we get a goodwill to the extent of 100 out here. Okay. So with the presence of the NCI, you cannot compare the PC and the net assets directly. You need to add to the PC the NCI and then compare it with the net assets. And of course, I'm considering the book values and the fair values to be common as well. Okay. Now let's come back. Now watch me carefully in terms of what I'm doing. One extra thing on the case number 2. Did this 300 enter the goodwill calculation? Yes. Did this 100 and 150 enter the goodwill calculation entirely? No. I can say this 150 and this 100 did not enter the goodwill calculation entirely, because if you go back and see mathematically what you are doing, you are indirectly saying that the PC is 300 and you're taking 80% of the net assets and getting a goodwill. So basically, in the calculation of the goodwill, you are considering only 80% of the net assets, which means that now if I look at on a mathematical level, you can say that in this particular case, you've taken 80% of this in the goodwill. The remaining 20% is not taken in goodwill. So the remaining 20% should appear in the balance sheet. I put it again, this 300 is entirely gone in the goodwill calculation, but this 250 is not entirely gone in the goodwill calculation. Only 80% went in the goodwill calculation. 20% never entered the goodwill calculation. So the 20% should appear in the balance sheet, and that is going to appear as an NCI. So 20% of that would appear in the balance sheet, and that is 50. So that would make it a perfect position, right? So you can see that on a mathematical levels, you need to be very clear that your investment gone fully in calculation goodwill. Your net assets, that is equity, 80% went to the goodwill, 20% which did not go to the goodwill should appear in the balance sheet. And since it belongs to the outsiders, that is NCI, it appears as a separate line item. Okay, I am now done with the consolidation. Now we can say investment went to the goodwill calculation, cannot appear in CBS. Equity share capital, other equity, 80% went to the goodwill, cannot appear in the balance sheet. 20% is appearing as an NCI. So in any case now, these three items still would not appear in the consolidated balance sheet. Even if there is an NCI in the picture, these three items cannot appear in the consolidated balance sheet. So we've got a thumb rule very well. Investments would never ever appear in the console. Equity share capital of the subsidiary would never ever appear in the console. Other equity of the subsidiary on acquisition date would never ever appear in the console. Goodwill as well as NCI would appear as a separate line item in the console, and you are now going to aggregate the assets and liability in full. You know, even if you've got an 80% stake in the company, the aggregation of assets and liability is always 100%, because the technique of consolidation is supposed to be a full consolidation under Ind AS 110. So whether you've got a 100% stake in the company or you've got an 80% or a 60% stake, aggregation of the assets and liability will always be 100%, because whatever belongs to the NCI is already being shown as a separate line item. So you can aggregate the current assets and the other assets. PPE is 500 and the current assets is supposed to be 300. And then you go back and equity share capital and other equity only from the logic in terms of consolidation. Otherwise, I could have simply given you the step, do this, do this, do this, and get the answer. But we need to understand the logics, the flow of how consolidation is done. I hope you are getting the logic. I've intentionally taken two cases so far. I'll take another two cases as well. The focus one is a consolidation on acquisition date without NCI. The case number two is a consolidation on acquisition date with an NCI. So now we're going to go to the third case. Let's do one thing now. We are going to do a consolidation, let's say a year later. So let's say when the position changes after 1 year, what is the position? Let's have a look. And before I take you to the case number 3 and 4, I want to give you something which is going to be very helpful when we come to another special issue that is regarding the changes in ownership interest. So what I'm going to do, I'm going to also give you another inputs, which I said earlier, maybe in terms of Ind AS 12, but I think it's time to tell you something more. You must see that how the consolidation is actually taking place. The investment of 300, see how it is getting replaced. Can I say as a part of the PPE, you've taken 200. As a part of the current assets, you've taken 100. And as a part of the current liabilities, you've taken this 50. And you've inserted this goodwill in any case. So you've inserted, you can say the net assets to the extent. So you've inserted the net assets, that's 300 minus 50. So you can say the net asset inserted is 250. So you can see that investment is getting replaced by goodwill 1. And the net assets, that is 250, 100% net asset. So you can say investment is being replaced. The investment has been replaced by the net assets plus the goodwill. The net assets is 250 and the goodwill is 50. So basically, what is a consolidated balance sheet? It's a replacement of the investment by the aggregation of all the assets and liability and the goodwill. That's it. Even if you see the other case out here, that is in case number 2, what you've done, you've inserted in the PPE 200, you've inserted in the current assets 100, you've inserted in the current liabilities, that is 50. You've also created an NCI to the extent of 50, and you've created a goodwill as well, and that is 100. Now see what you've done in this particular case. If you look at the net assets, it is again 250. The net assets is 250. So what is the investment getting replaced by? Can I say the investment is replaced by what? The investment is replaced by net assets minus the NCI plus the goodwill. It is getting replaced by the net assets minus NCI. You took the full net assets, then you took NCI. So indirectly what you've taken the share in the net assets. In the previous example, you replaced the investment with the net assets, you got 100% stake. In this case, you're replacing the net assets by 250, but at the same time, you're also reducing the NCI. So you are basically taking the share in net assets plus the goodwill. So you can say that the consolidation is what? Investment gets replaced by three things: 100% net assets, NCI, and goodwill. Or you can say it gets replaced by share in net assets plus goodwill. So whether you say share in net assets plus goodwill, or you say that it gets replaced by 100% net assets minus the NCI plus the goodwill, it's one and the same thing. So remember, the investment account in the consolidated balance sheet is nothing, but it represents the share in the net assets plus goodwill. Now, if you go back to Index 12, which we did earlier, you would recall at that time when I was explaining the difference between the investment in the consolidated balance sheet carrying amount and the tax base of the investment. Now you would understand it better with the logics out here. That investment every time in the consolidated balance sheet is a reflection of your share in the net assets of the investee plus the amount of goodwill. And the goodwill keeps constant at 50 unless it gets impaired, and the share in the net assets will continuously change, because if the subsidiary is earning a profits over a period of time, then naturally the share in the net assets will improve. Right, friends? I guess I am pretty clear so far at this stage. I guess so. Okay, now let's go to the case number 3. So 2 cases done. Now the focus is on case 3. So I've given you the inputs: consolidation acquisition date without NCI, consolidation acquisition date with NCI. Now we want to take it further, let's say 1 year later. So let's go to the case number 3. So what I'm going to do, I'm going to make some changes to the case number 1, push the balance sheets of the parent and the subsidiary a year later, and let's have a look at that. So let me just create a balance sheet for the holding as well as for the subsidiary. Some figures I'm going to keep the same, but some figures I'm going to make changes. And in this particular case, I'm taking that holding company, let us say it's got 100% stake in the subsidiary. I'm not taking NCI, but these are the balance sheets not on the acquisition date, but let's say 1 year later. So I'm looking at the balance sheets of both the companies 1 year later. So I want to see the consolidated balance sheet, which is 1 year later. So third case is focusing that you are doing a consolidation which is year later. Then how does the concept change? Watch me now very carefully, friends out here. So I'm going to take the same base as the first example, make some slight changes in this particular case. So let's do one thing. Let's go back to the example 1. So I think I'm going to keep the investments same, equity share capital and same. So let me take this. Equity share capital is 100, and let's slightly change the other equity. So equity share capital and other equity and current liabilities and PPE and the current assets. So let me keep the share capital 100 itself. Other equity, let me slightly make it as 250, and PPE, let's take it 250, current assets 120. So slightly making some changes in the figure due to some movements, and let's take the current liabilities as a balancing figure. So this is going to be 370 minus a total of 350, that works out at 20. So this is the movement after 1 year. Some things have increased, some things have decreased. Here again, let's take the PPE, and then there is investment in the subsidiary, then there is current assets, equity share capital, other equity, and let's take the current liability. Let's keep the share capital same. Let's keep it as 200. So let's keep it as 200, and other equity, let's take it 650. And we keep the investments also same, 300 itself. So let's keep the investment 300, the PPE is 400, and let's change the current assets to 250. Just taking some arbitrary figures, and I think this is 100. So this is 950, 950, 370. Yes, perfect. Okay. So what I've done, I've taken the balance sheet 1 year later with no NCI. So the focus is consolidation at a later date, not acquisition date, without NCI. The fourth case is going to be with NCI, so that's going to be fun. And then we are going to develop some basic rules of consolidation to do with. Okay, let's go with the picture now. Okay, now the question arises, would the goodwill computed in case 1 remain the same in case 3? The case 3 is an extended version of case 1. Where I'm just giving you the position 1 year later. So do you think goodwill will change? Goodwill can only change if there's been some impairment. So I'm not considering any impairment. So I would say goodwill remains same. The goodwill remains the same unless there was impairment. Unless there was impairment. So if there was an impairment loss on account of goodwill, it would have undergone a change. But I think since there is no element of, you can say, impairment, goodwill remains the same. So let me go back to the case and see what was the goodwill. The goodwill was 50. So let's take the goodwill as 50. Now, watch this carefully. This is a crucial step, and watch this very carefully on the crucial step. Now, let me ask myself a few questions. Have I taken this investment in the goodwill calculation? Yes. Fully? Yes. Have I taken the equity share capital in the goodwill calculation fully? Yes. Have I taken the other equity in the goodwill calculation? No. No. This 250 is a total of 150 plus 100. 150 is the equity on the date of acquisition. And 100 is the increase, which is the profits earned in the post-acquisition period, mind you. So we can say this 250 is what 150 is equity on date of acquisition. So this is the equity on the date of acquisition. And what is this 100? This is, you can say, the post-acquisition profits, which is earned by the subsidiary company after the acquisition date. So now let's get this very clear. Is this 300 gone in the goodwill calculation? Yes. Is that 100 gone in the goodwill calculation? Yes. Is that 150 gone in the goodwill calculation? Yes. Is the 100 gone in the goodwill calculation? No. So would it appear in the consolidated balance sheet? Yes. So what we're going to do in this particular case, since the parent company as a 100% stake in this company, he will say that whatever is the earnings of the subsidiary, it belongs to me. So he's going to merge that equity as a part of his equity. So he will say that whatever is the post-acquisition earnings of the subsidiary company, since I've got 100% stake in that company, 100% of that post-acquisition earning belongs to me. So line by line addition, just like you're going to add the assets and the liability line by line, you're also going to add the post-acquisition share. So this is the share of the holding in subsidiary post-acquisition earnings. So we need to complete a double effect, that anything which you're aggregating in the balance sheet should be done. Now the investment gone in goodwill, share capital gone in goodwill, other equity gone partly in goodwill, and the post-acquisition got inserted in the balance sheet. I hope you are getting the mathematical logics of things. I'm basically explaining you these cases so that you get the logical process of why do we do that. I could have simply given you the steps as well, that this is done, step 1, step 2, step 3. But once I'm going to give you the steps, you'll understand that why I'm doing those steps. So we're developing the logics. Okay. I guess now my balance sheet is done. Now what I'm going to do, I'm going to apply the aggregation of the assets, add the PPE, that is 650. Add the current assets, that is 370. Aggregate the assets and aggregate the liability, that's 120. And of course, the share capital and the other equity can appear only for the parent company because in this particular case, subsidy doesn't appear except the post-acquisition. So the equity share capital is 200. Other equity you've already taken. Let's see the total. This is 950 and 1070. This is also 1070. The balance sheet is agreed. Wow. I'm now able to develop certain fundamental rules. I'm not saying principle again. I'm very careful using the word rules for consolidation. Now let's get some rules quickly before we go to the case number 4, which is the final version of getting our final list and will document. Number 1, investment would never appear in the console. 1. Equity share capital, the subsidy, would never appear in the console. 2. Equity on the date of acquisition would never appear in the console. 3. Investment would never appear. Equity share capital would never appear. Other equity on date of acquisition would never appear. That is 3. Goodwill NCI would appear as a separate line item. That is 4. Aggregate all the assets and liability 100% even if there is NCI. That is 5. And just remember that when you take the equity in the balance sheet, you take holdings own equity and the share in the post-acquisition earnings as well. Wow. I hope I am pretty clear on the picture. Let's now do the case 4. Let me see if any questions coming in. I don't think so there would be questions coming in. Yes, there are no questions coming in because this is too easy. I don't think so. Your mind should ask you questions at this stage. Okay, let's now go to the case number 4 finally. So we are now on the case number 4, which is the last case. And any questions on consolidations has to fall in either of the 4 cases. If you've got any question, it cannot be a 5th case. All the questions go to fall in 4 cases. So what I've done, I made a list of the assignment where all the questions have been put in either of these 4 cases and life jingalala. Okay, so let's do one thing now. We are considering that holding is got in the subsidy 80% stake. So I'm going to take the case number 2 as a base and the balance sheet, which I gave you in case 3. Let me just make the consolidated balance sheet with an 80% stake. So let's have a look at the consolidated balance sheet. This is again 1 year later. So I'm going to take the balance sheet from case 3, but with an 80% stake, which we covered in terms of case 2. So the question what comes back again in the mind, is the goodwill going to be the same what we did in case number 2? Can I take the same goodwill which I took in the case number 2? Yes, if there is no impairment, of course, yes. So we can say goodwill remains the same. Goodwill remains the same unless there is impairment loss. So unless there is impairment loss, and I'm not taking any impairment loss in the question. So if there is no impairment loss, the goodwill continues to be the same. I think it was 100. Let me just take it back. Yes, we got a goodwill to the extent of 100. So goodwill remains the same. Goodwill computed on the acquisition date continues to be the same year after year in a consolidated balance sheet unless there has been some impairment. Otherwise, the goodwill does not undergo a change, or there is a change in the percentage ownership, etc. Let's not take those things at the moment. Okay. So now coming back to the picture. So we're back on the case number 4. Now we are considering the information on case 3. So let's do one thing again. Now, is this investment gone in the calculation of the NCI? Is this investment gone in the calculation of goodwill? Yes. Is the equity share capital gone in the goodwill? No, 80%. 80%. Is that 150 gone in the calculation of the goodwill? No, 80%. So 20% was the NCI. So here again, we're going to take the NCI that was 50. So we take the same NCI that was 50. So this was the net assets on the date of acquisition with a 20% stake that was 50. Now let's see it back. Now let's see back. So goodwill NCI, same what you took in case number 2. Now let's watch it again. Is this 300 gone in the goodwill? Yes. Is this equity share capital gone in the goodwill NCI? Yes. Is this 150 gone in the goodwill NCI? Yes. Is this 100 gone in the goodwill NCI? No. So this 100, which is a post-acquisition earning, 80% belongs to the parent and 20% belongs to the NCI. So what do you need to do in this particular case? Out of that 100, when you take the other equity, what are you going to do in this particular case? So when you're going to consider this amount of profit 100, so we can say out of that 100, 80% belongs to the parent and 20% belongs to the NCI. So in the previous case, the entire post-acquisition earnings was added to the other equity because the parent company had 100% stake. But in this case, since he's got an 80% stake, 80% enters the other equity and 20% enters the NCI. So whatever is the post-acquisition earnings of the subsidiary got split into two portions, the portion belonging to the parent as a part of the other equity and the parent portion belonging to the NCI as a part of the NCI. I hope the logics are getting wonderfully clear. Okay, then I think my balance sheet is done. Now you can simply aggregate the assets and liability in full, irrespective of the percentage. So PPE is 650. And the current assets is 370. So this is the assets aggregation. The equity share capital only for the parent company, that is 200. And we also take the other equity of the parent company, that is 650. And you take the current liabilities, that's 120. And I think this is done. Let's see the consolidated balance sheet is prepared or not. So 750 plus 370, that's 1120. And this is, let's see, is it matching? Yes, it is a perfect match. The balance sheet is agreed. And that explains me how the consolidated balance sheet is done. How the consolidated balance sheet is prepared. We've got certain set of rules. And I'm going to add to these rules one more rule as well. Though we'll see how do we apply that once I give you the rules. But I think now I'm ready in terms of giving you a step-by-step procedure that if you want to make a consolidated balance sheet, what is the process? Okay, so let me see if any questions coming so far. No. Okay, so are we absolutely clear, friends? Let's get your inputs on that. Are we absolutely clear with the process of consolidation? Is these four cases helped you to get the fundamental rules clear with the logics? That what is the technique of consolidation? Let's now document things with you. So I am now going to document the things with you, and I am going to give you these steps for preparing consolidated balance sheet. We'll see a consolidated P&L question also tomorrow. So first we're going to concentrate on steps for preparing a consolidated balance sheet. We'll talk of a P&L also, but let's first concentrate on a consolidated balance sheet. Now the rules are pretty simple and straight. Now see this, step number one. Well, I would say when you start off a question, you need to identify two things, get the percentage and get the date of acquisition. This will not be a big exercise at all. It's going to be a very simple exercise. Read the question, organize the acquisition date, and organize the percentage. That's it. You just need to organize the data. That's it. Then you go to the step number two. Now watch this carefully in terms of step two. I would say the question would either be a case 1 and 2, where you're required to make a consolidated balance sheet on acquisition date with without NCI. Or you may be given a question of a case number 3 and 4, where you're required to do a consolidation a year later. Now let's get this very clear. You need to watch out that the question belongs to which case. If you get a question on case 1 or case 2, and if you get a question on case 3 or case 4, now watch this carefully. At the end of it, if you notice for goodwill, I need the net assets on the date of acquisition. Mind you, for the goodwill, what I need is the net assets at date of acquisition. The net assets at date of acquisition is as good as equity at date of acquisition. So for the purpose of goodwill, for the purpose of goodwill, you need the net assets at acquisition date, which is as good as equity on the date of acquisition. Now, what is equity on the date of acquisition? If you notice the techniques I've done, I have taken the sum total of the equity share capital plus, you can say, the other equity at date of acquisition. So basically, if you look at the equity, there is 250, which was given. I need equity on date of acquisition. So the share capital 100 plus the equity on the date of acquisition. Now, if you're given a balance sheet on acquisition date, getting this information is easy. If you're doing a consolidation on the acquisition date, the subsidiary balance sheet will clearly tell you the other equity at date of acquisition. So in case number 1 and 2, getting this other equity at date of acquisition, you can say, is already given in the question. It'll be already given in the question. So I don't need to do anything to get that information. You know the subsidiaries balance sheet. And in the subsidy balance sheet, the equity share capital and the other equity can be directly picked up, and you know the information directly. But when you're given the case number 3 and 4, he will give you the other equity 1 year later. So I need to split that 250 in terms of what is acquisition date and what is post. So what I'll have to do in case number 3 and 4, I'll have to do the analysis of other equity. I'll have to do the analysis of other equity, and this analysis of other equity means splitting this equity between what is there on the acquisition date and what is post. So we will split this. We will split this between, you can say, pre-acquisition profits and the post-acquisition profits. Let's get this once again very clear. Step number 2 is analysis of other equity. You need to see, let me just take you back and correlate this with this example. If you notice, when I did the case number 1 and 2, this is the equity on date of acquisition apparently given in the question. So I don't need to do the analysis of this equity. I know that this equity is entirely the pre-acquisition equity. So analysis is not required. But when we went to the case number 3 and case number 4, we needed to analyze that what is the breakup of this other equity, what is pre and what is post. So if in the question you are given to consolidate a year later, 2 years later, 3 years later, whatever, you need to basically do an analysis of the other equity, get the bifurcation. How that analysis is done, we'll see in a practical illustration. No worry. Now you would say, sir, why are you looking at equity as the sum total of share capital and other equity? Why didn't you take the list of net assets? Well, I think there are 2 techniques, but the easier technique would be to get the other equity as share capital plus other equity instead of getting a net assets on the date of acquisition, which can be a technical exercise. So I would say the better approach in terms of things is, if you want to organize the net assets for goodwill calculations, don't take the net assets as assets minus liability unless you are given a balance sheet on acquisition date. The best approach is always to consider the sum total of the share capital and other equity. So if you're given a balance sheet at a later date, you need to analyze this equity, that what is pre and what is post. So when you are looking at the step number 2, watch out very carefully. If the question is case 1 and 2, you don't need any analysis. The information is directly given. You don't need any analysis of other equity. The analysis, you can say the step number 2 will be required only if it is case 3 and 4. We'll do an analysis and get the split of equity. Right? And after you do the split of equity, also calculate the net assets as well, taking the sum total. So in the step number 2, you can do 2 exercises. Step number 2A, where you do the analysis of equity. And step number 2B, where you calculate the net assets on acquisition date. So I would say in step 2, go with the 2 steps. Step number 2A, do the analysis of equity, get the pre-post. And then step number 2B, get the net assets on the acquisition date for the purposes of the goodwill. Okay, this is step number 2. Now let's go to the step number 3. So once you're done with the step number 2, we go to the step number 3. And in terms of step number 3, now I would say in a question, where you get a consolidated balance sheet, the examiner may not disturb you in terms of calculating a purchase consideration. The investment appearing in the balance sheet of the holding company itself is the purchase consideration. So maybe the examiner doesn't trouble you. So I'm not getting to the step 3 that calculate a PC. I assume that the purchase consideration is as good as the investment in the balance sheet of the parent. So step 3 would be simply calculating NCI. So when you calculate the NCI, now be careful. You need to consider the NCI at date of acquisition, which will be based as per Ind AS 103. Either you've taken a fair value or you've taken, you can say PASNA, whatever the case might be. So you would have taken this either on the basis of a fair value or on the basis of PASNA. And then to this, you need to add the share in post-acquisition profits. You need to add the share in post-acquisition profits. So this is what you need to do. If you remember, I took the NCI on the date of acquisition 50 in the case number 4, and then I added the share in the post-acquisition profits, that is 20% of 100. So you need to get this figure very clear. What is NCI on the acquisition date plus the share in the post-acquisition earnings? Step number 3 is done. Then we go to the step number 4. Go on a step-by-step basis, friends, and you'll never ever get any troubles, because you know at each stage what you need to do. Your focus is completely on that step. The step number 4 is to calculate the goodwill or the bargain purchase gain. And trust me, this is 100% same as Ind AS 103. This is going to be 100% same as Ind AS 103, because when you're calculating a goodwill, the goodwill is already computed on the date of acquisition, and that is by virtue of Ind AS 103. Wow. Step 4 is done. Then we go to step number 5. Now, in terms of the step number 5, I would say this is a crucial step, and I would be adding a few more items as I go to the practical illustrations with you. Right now, I think there's not much inputs to be given, but the step number 5 is very crucial. I would say you are going to prepare a note to calculate the other equity to be shown in the consolidated balance sheet. I need to basically, make a working that what is the other equity in the consolidated balance sheet of the parent. Now, when you look at the other equity, you've already seen something. You take the other equity of the parent company, and then you add the post-acquisition share, right? If you remember, out of that 180%. So when you take this other equity, you need to be careful that you need to consider holding company's own other equity that is taken, and to this we're going to add the share in post-acquisition profits. We're going to add the share in post-acquisition profits, and this will give you the amount of other equity. There might be more adjustments, but we'll see those adjustments at a later stage. So all you need to take care is take the profits of the other equity of the parent and the share in the post-acquisition profits. And this is what you're going to get from the information in step number 2. In step 2, you will already get the post-acquisition earnings. Just take the figure and multiply this with the percentage held by the parent company. Step 5. And then finally, we go to the step number 6. And the step number 6 is making a consolidated balance sheet. Now, when you're going to make a consolidated balance sheet, I have already developed a set of rules with you, and you're going to keep all those rules of consolidation in your mind at this stage, that when you consolidate, what is not to be taken in the console. So let's make the rules for making a consolidated balance sheet. So let's now document all those rules as far as making a consolidated balance sheet is concerned. So we've got rule number 1. We can say equity share capital of only holding company is taken. Instead of saying that what is not taken, I'm putting the rule that the equity share capital of only holding company is taken. In the brackets, I can make a mention, equity share capital of subsidiary company is not taken is not taken in consolidated balance sheet. And you know the logic why it is not taken, because it goes in the calculation of the goodwill and it goes in the calculation of the NCI. The second one is other equity. The other equity is going to be taken completely based on step number 5. So the other equity is going to be taken completely based on the step number 5, which means we can say subsidiaries company other equity, that is pre-acquisition other equity, is not taken in the balance sheet. So though we have already made the steps, so we know that other equity will be parent's own and the subsidiary and the parent share in subsidiary post. Pre-acquisition subsidiary portion is not taken. Number 3, investment, which is holding in subsidiary, is not taken in consolidated balance sheet. So when you prepare the consolidated balance sheet, we're not going to consider the investments as well. So equity share capital, other equity investment parameters. Then number 4, goodwill and NCI are reflected. Goodwill and NCI are reflected as separate line items, in balance sheet. Now, let me also pinpoint something at this stage. When you say that goodwill and NCI is reflected as a separate line item, goodwill, of course, would appear as a part of the NCA. NCI would appear as a part of equity in the balance sheet immediately after other equity. So as a presentation, also keep this in mind, that as far as the goodwill is concerned, this will be appearing under NCA, non-current assets. And as far as NCI is concerned, it will be under the heading other equity, last item. So when you consider the after other equity, I would say after other equity. So it's a part of the equity. So after other equity, just present that as a last item in the equity section of the balance sheet. Okay, so this is rule number 4. Then let's come to the rule number 5. We need to aggregate 100% assets and liabilities. We need to aggregate 100% assets and liability irrespective of the NCI. Irrespective of NCI. So whether there is an NCI or not, you've seen in all the cases that we're aggregating 100% assets and liabilities all throughout. So these are the major 5 rules which we need to keep in mind as you prepare a consolidated balance sheet in step number 6. Share capital only for the parent, then other equity, parent and post-acquisition share, investments not taken, goodwill NCI separate line items, and this goodwill NCI will be computed already with you in terms of step number 3 and 4. So step number 3 and step number 4 will give you that information as well, then aggregate everything into account. I'll not say the 6th rule, but I would say that let's put it as a note so that you remember 5 things and consolidation is done. 5 fingers, and then there is a small little note, sometimes 6 finger in the hand. So let's also give you that apart from this, there is something more which we need to take care, which of course I'll elaborate when I come to the practical questions on consolidation. But what extra you need to do at this particular stage is you need to eliminate, when you make a consolidated balance sheet, you need to eliminate 2 things. One is you need to eliminate the intercompany owings. We will see in certain questions, there might be a common debtor-creditor relationship which is present between the parent and the subsidiary. So when you go to aggregate the assets and liability, naturally you'll aggregate the debtors and creditors of both the company. So if there is any common intercompany owings, that needs to be eliminated. So we'll see how that elimination is done. And we need to eliminate certain unrealized profits as well. We'll talk of this unrealized profits very soon, explaining you the concept of downstream and upstream transactions in terms of unrealized earnings. But when you make a consolidated balance sheet, you need to remember that these are 2 further things to be taken care of. Elimination of the intercompany owings and the elimination. Now, As far as the elimination of intercompany owings is concerned, I can outrightly say that this will always be done in the balance sheet. But unrealized profit earnings would depend. I'll make some changes when I discuss that sometimes I will do the elimination in step number 5. And sometimes I'll do the elimination in step number 2. So depending upon the kind of transaction, don't get worried on this right now, that I would either eliminate the unrealized earnings in step 2 when I take the analysis of equity, and I would sometimes eliminate the unrealized profits in step number 5 when I make a working note on the other equity. Okay, so far so good, friends, on that. I think what I've covered so far with you, I have given you all the rules in terms of consolidation with logic. Now you know why each and every step is being done. So I think if you quickly have a look in terms of these steps, so we can start doing questions with you, not today, of course. We'll do the questions with you tomorrow. But you get this very clear. Step number 1 is just getting the acquisition date and percentage. Step 2 is analysis with net asset. Step 3 is NCI. Step 4 is goodwill. Step 5 is getting the other equity in the balance sheet. And step 6 is making a consolidated balance sheet. So these are 6 steps which we're going to follow religiously in every question to do a consolidation. Apart from this, you could also get a question on consolidation in terms of a chain holding. Tomorrow, we're going to apply all these steps with you, and we're going to do questions with you on consolidation. We'll do some past examination questions with you, including the chain holding, and that's how the consolidation process will get over. Then there is a small little section which deals with the changes in ownership. Time permits tomorrow, which is highly unlikely. Otherwise, we'll do that on Monday along with India's 111. That's all for the day, friends. Let's see if you've got any questions coming in. Otherwise, we're going to call it a day. Okay, I think Janvi has got a question. So we take care of the fair value of NCI. So won't we consider fair value of the assets at the date of balance sheet? That is 1 year after. No, when you take the NCI on the date of acquisition, it is taken on the basis of Index 103, irrespective its fair value or irrespective it is PASNA. Then you just need to add the post-acquisition share. No worry, we'll be doing practical illustrations with you and looking at the applications of these steps, of course, in detail. Right, friends, so I think that's all seems to be good for the day. I guess no further questions coming in. So I think it's time to bid goodbye, friends, to you at this stage. So I'm going to join you, friends, in the morning today again. So please do revise what we have done today. See you in the morning tomorrow. Bye-bye and take care.